kinds of different policies. We are not big in the commercial multiple peril business. So, I mean, this is not like our auto business or anything of the sort. But we will have claims, we'll have litigation costs, but proportionally, it's not the same with us as with some other companies which have been much heavier in writing business interruption as part of a commercial multiple peril. But you don't automatically get coverage if you have business interruption. I mean, for example, I think it would be unusual if, say, General Motors had a strike, which they did, and that they have business interruption that covers the strike. We actually wrote about, probably the only annual report in the United States, we wrote about business interruption insurance because we had it over in France when one of our properties was adjacent to a property that's much smaller property that had a fire, and then it spread to our plant, and it caused a lot of physical damage, and we have business interruption that ties in with that. But if we had some company we were selling auto parts to and they had a strike, our business would be interrupted, but it's not covered by that is not part of the coverage unless you specifically really buy it. So there's some claims that are going to be very valid related to this, the present situation. There'll be an awful lot that there'll be litigation on that won't be valid, and there's no question that some insurance companies, I know one in particular, that will pay a lot of money relative to their size in terms of policies that they've written. And I think we have reserved, and our history shows we generally have reserved on the conservative side adequately, at least. And that's certainly our intent. And we tell no managers of any of our insurance operations what numbers we expect from them or do any of that. That they evaluate their losses and they build in something for social inflation. They build in things for all kinds of things. And generally speaking, Berkshire's been pretty accurate in its reserving, and I have no reason to think that we're otherwise than that currently.
Stephen Tedder from Atlanta, who says he's a 10-year Berkshire shareholder, writes in and he says, do you see Berkshire offering pandemic coverage in future insurance policies?
Well, the answer is we insure a lot of things. Sure. I don't. We had somebody come to us the other day wanting insurance involving a $10 billion protection on something very unusual. We're not going to make that deal in all probability. In fact, I would say it's dead. But we would have written pandemic insurance if people had come to us and offered us what we thought was the right price. We would have been wrong, probably, in doing it. But we have no reluctance to quote on very unusual things and very big limits. We're famous for it. We haven't done that much of it in certain periods because the prices aren't right. But if you want to come and insure almost anything, and we don't want you to insure against fire if you happen to be a known arsonist or something. But if you come to us with any unusual coverages, either in size or in the nature of what's covered, Berkshire is a very good place to stop. And so somebody wants to buy, they can dream up the coverage and they can tell us the price they'll pay, and we'll consider writing it. We wrote a lot of business after 9/11, for example, and there were really only a couple companies in the world that were willing to write the business. And Berkshire and AIG wrote a lot of business, and we thought we knew what we were doing, but we could have been surprised. I mean, there could have been some follow-on incidents from 9/11 that we wouldn't have known about. You don't know for sure the answer. That's why people are buying insurance. But we would be willing to write pandemic coverage at the right price.
This next question is for Greg, and it comes from a shareholder named Todd Flaska. He says, I don't expect Berkshire to outperform the S&P 500 during good times. However, I remain a long-term investor because of the huge war chest that can be deployed during the downturns in the market like we're seeing right now. Warren has been brilliant at negotiating mutually favorable deals with companies that have somewhat urgent capital needs during these downtimes. These opportunities may only come about once a decade. There's a small window of time for these deals. They all come at once, and you don't really know if you're at the bottom of the market when the deals start coming. Will Berkshire be able to continue this approach when Warren and Charlie are no longer at the helm?
I fundamentally, without Warren and Charlie at the helm, I don't see the culture of Berkshire changing. I don't see our ability, which a large part of that is having the business acumen to understand the transaction, the economic prospects, and then the ability to act quickly. I really don't see that changing as we evolve. Listen, there's no one better than Warren and Charlie, but equally, we've got a talented team in Berkshire, both at the Berkshire level and within our managers that can obviously look at opportunities too very quickly. But, the reality is it's a huge advantage we have right now, and we would clearly want to be in a position to maintain that position of strength. Warren?
Yeah, we will maintain it, and we not only have it with the managers of in some cases, not all cases by a long shot, but in some cases we have managers that will occasionally come up with something that can be quite attractive. But between Greg and Todd and Ted, we've got three extraordinarily good minds in terms of allocating capital. And Charlie we may get an occasional call because of someone we knew 20 years ago or something, but they know a lot more people. They've got a lot more energy, and their minds work the same way as ours have in the past. So I think it could very well be a significant improvement when the three of them are thinking about capital allocation than when Charlie and I are now, and particularly now that he's found Zoom.
All right, this next question comes from Max Rudolph in Omaha, Nebraska, and he asks if Berkshire or any of its fully owned businesses have participated in any of the bailouts from the Fed or the Treasury.
I certainly don't know of any. I guess you could say while we own the airlines, the question's about fully owned businesses, and there's no way that I wouldn't know about anybody that did any of that. Greg?
No. In fact, we've been very clear with the businesses, but our businesses understood how Berkshire operates, and equally we're very clear that we would not be participating in any of those programs or quote bailouts.
This is a similarly related question. It comes from Seth Frieden, who says, as a long-term shareholder of Berkshire B shares, would like to know Warren's viewpoint around smaller holdings, specifically Oriental Trading Company and Nebraska Furniture Mart, that are based in your hometown of Omaha. He imagines that those smaller business units have been adversely impacted by COVID shelter-in-place mandates. So would like to know if Oriental Trading or other small business units applied for PPP loans or participated in those acts. And if they didn't qualify for a loan or didn't participate, then how will Berkshire support those smaller businesses to make sure that they can continue to employ their employees?
Yeah, well, to my knowledge, none of them have gone in for government money, and the two that are mentioned, I don't like to get into specific companies, but I can assure you that the Nebraska Furniture Mart and Oriole Trading, in my view, have a fine future. But I don't want to go down the list, obviously, of every single company, because some of them I don't know the answer to. We actually decided some time ago that our newspapers would have a much better chance of surviving if they were run as part of a Lee than if we ran them independently. And as I said earlier, we actually put considerably more money. We probably put more money in the newspaper business than virtually anybody in the country in the last 6 months, because we took over a loan that would have been a problem in the year, whatever it might have been, maybe a year and a half. And we enable them to just deal with one lender rather than a group. And they are doing a better job with the newspapers than we would do. And that's always our preference. If we've got a business that does not have, looks like it is not going to sustain itself over time in our hands, if we can find somebody else that we think will do a better job, we'd love to have them run it. So if we have a problem business, we would prefer to find somebody that thinks they can do a better job, and probably can do a better job of running it than we can. But some businesses just disappear. We started with the textile business. We started a company called Diversified Retailing, which merged into Berkshire, became part of Berkshire, and it started with a department store in Baltimore. And department stores looked good in 1966, but the world has gone against them. And we had a trading stamp business at one time, and we stayed longer than anybody else. But the world left trading stamps behind her, and that's going to happen with some businesses. That's capitalism, and it will happen to some Berkshire businesses over the next 10 years and the next 50 years. We think we'll find more of them that will grow, and net that Berkshire will grow. But we do not think, if you own a great many businesses, that everyone is destined for success. That's why I suggest to people they buy an index fund. I do not, with the exception of Berkshire, I would not want to put all my money in any one company, although there's a few I wouldn't mind being very close to that. But I don't think, you get surprises in this world, and there will be businesses that we think are very good that turn out not to be so good, and there will be other businesses that turn out better than we think, and it's up to the world to judge our batting average over time. Greg? Yeah.
Well, I would just add and echo again that when it comes to the PPP loans, we're not aware of any of our businesses taking them, and as I said, we encouraged them if they were ever thinking that there was going to be a dialogue, and we're not aware of any businesses pursuing them. I would also just add that when you look at our businesses as we went into the crisis, they responded very well. So as we look at our businesses, and Warren touched on this, our large businesses, our mid-sized businesses, and even as you go down from there, they're in very sound shape as we go through the pandemic, and are really preparing to emerge now. So they're evaluating, listen, they're going to have a different customer. There's going to be different consumer behaviors, how our employees work. A lot of them work at home now. Does that make sense? And the communities we're operating in have all changed, but we're literally moving from the point of, okay, we're making it through the crisis and really planning to reemerge now. And I would say our businesses are in an extremely sound place.
We don't know when
This next question.
Well, I was just going to say,
Yeah.
but we don't know. We don't know how long this period lasts, and nobody knows. We don't know whether most people think, and they know more about it than I do, that the virus will, to some extent, decline in its spread during summer months. And I would say a good many think that it will come back at some later date. And how the American public reacts if they get their hopes up through some reopening, some through some summer diminution, and how they would react to a second attack in effect by the virus. It's like Dr. Fauci, the virus is going to determine our behavior. And we're doing a lot of smart things, and we've got a lot of very smart people, but there are unknowns, and the unknowns that apply to the health aspect create unknowns in the economy, and we'll have to keep evaluating things as we go along. I hope, like crazy, obviously, that once suppressed, it doesn't come back, and that we readjust. But things don't always work perfectly. That doesn't mean there was a better course of action. I would not go around criticizing people at all for what they've done or anything of the sort. I just think you're dealing with a huge unknown, and I think that the degree to which it's disturbed the world and changed habits and endangered businesses in the last couple of months indicates that you better not be too sure of yourself about what it'll do in the next 6 months or year or whatever.
Warren, a moment ago you mentioned that you still are recommending that people invest in an S&P 500 index fund. Let me ask this question that came in from Kevin. He says, the last few weeks we've been hearing from active money managers that the day of passive investing is over. The historical safety of investing in an index fund long-term is gone. Would you please provide your thoughts on this topic, particularly in regards to an investment time span of 10 years?
Well, I can tell you I haven't changed my will, and it directs that my widow would have 90% of the funds in index funds, and I think it's better advice than people are generally getting from people that are getting paid a lot to give other advice. You don't make a lot of money advising an S&P 500 index fund. I mean, how you can say the day of index funds is over? I mean, if you say the day of investing in America is over, I would disagree quite violently. And then is there something special about index funds being a terrible way to invest? I just don't think it's very hard to have evidence of that. I mean, if the index funds reflect the market, and one side has high fees that think they can pick out stocks, and the other side has low fees, I know which side's going to win over time. And you have to recognize that it's in a great many people's interest to convince you that they can do something that they may well even believe they can. And a certain percentage of them will do it from luck, and a few people will do it from skill, and that's what makes it so enticing that you can find the Jim Simons or somebody that's going to produce extraordinary return. And Jim and his group have done it by brain power. But it's very unusual, and incidentally, they are going to charge you a lot of money, and they're going to actually maybe close up their fund if they do it, because they can't do it with really huge amounts of money compared to how the record's been established in the past. So you just have to recognize you're dealing with an industry where it pays to be a great salesperson, and it pays even better if you're a great salesperson and you can actually produce something. But the money is in selling. There's a lot more money in selling than in managing, actually, if you look to the essence of investment management.
I got a number of variations on this next question, some more polite than others. This one's right about down the middle. But this is from Mark Blakely, who writes in from Tulsa, Oklahoma, and he says, like many, I'm a proud Berkshire Hathaway shareholder. However, in comparing the performance of Berkshire with the S&P 500 over the last 5, 10, or 15 years, I've been disappointed in Berkshire's underperformance. Even year to date, Berkshire is trailing the S&P 500 by 8%. To what would you attribute Berkshire's underperformance? Well, I can't imagine ever selling my Berkshire stock. At some point, money is money.
Well, I agree with everything that I forget his name, but said. I mean, the truth is that I recommend the S&P 500 to people, and I happen to believe that Berkshire is about as sound as any single investment can be in terms of earning reasonable returns over time. But I would not want to bet my life on whether we beat the S&P 500 over the next 10 years. I think I obviously think there's a reasonable chance of doing it, and we've had periods, I don't know how many out of the 50, 55 years we've been doing it, or I don't know how many we've beaten or not. I mentioned earlier that 1954 was my best year, but I was working absolutely with peanuts, unfortunately. And I think if you work with small sums of money, I think there is some chance of a few people that really do bring something to the game. But I think it's very, very hard for anybody to identify them. And I think that when they work with large funds, it gets tougher. And it's certainly gotten tougher for us with larger funds. And I would make no promise to anybody that we will do better than the S&P 500. But what I will promise them is that I've got 99% of my money in Berkshire, and most members of my family may not be quite that extreme, but they're close to it. And I do care about what happens to Berkshire over the long period, about as much as anybody could care about it. But caring doesn't guarantee results. It does guarantee attention. Greg?
Well, I would agree, Warren, that there's never guarantees, but when I look at the assets we have in place and the teams that are in place, i.e. you're committed to Berkshire, but we have dedicated teams that equally are dedicated to Berkshire, and they're sure going to give it their best effort every day. And when I look at the assets and the people, I think we have, as you said, you can't guarantee it, but we have a great chance of sure giving a good effort to outperform it.
It's hard to imagine getting a terrible result with Berkshire, but anything can happen. And what I do know is it would be easier to be running $5 million than our book net worth at Berkshire at the quarter end, I think, was $370-some billion, which is down, but it's still greater than the book net worth of any corporation in the United States. It's probably, maybe there's some federal corporation that has more, but in terms of it may be the greatest in the world. I'm not sure.
When I would
and
add,
that makes life difficult in some ways too.
Right, and the potential of our operating businesses are substantial. When you think, we've talked about energy, you touched on it, that infrastructure is continuing to change. We're ready for $100 billion of investment opportunities there. If we just look at the business over the next 10 years and the infrastructure that's required and how it's changing, substantial investments there, that just tell me we have very good prospects. And we're well positioned to pursue them. Which again, to me, when you look at our core businesses, you touched on them, Burlington, the insurance and energy. It's tough. Our downside is very nicely protected. We have three really core great businesses.
Yeah, and we're better positioned than anybody in the energy business. Just because we don't have dividend requirements, we've retained $28 billion of earnings over 20 years. That you can't do it if you run a normal public company. And we've got a huge appetite, and the country needs it. The world needs it, and we are a very, very logical, well-structured, well-managed, I would say, because it doesn't involve me, company to participate in just huge requirements around the world. Now, they're slow and they involve governments and state governments, and there's a lot of. It's not anything that happens dramatically. It will happen, and Berkshire should participate in a huge way. We can do things in insurance nobody else can do. That doesn't mean much many times, but occasionally it may be important. So there are some advantages to size and strength. But there are disadvantages to size too. If we find some great opportunity that for $1 billion to double our money, that's $1 billion pre-tax, and that's $790 million after tax, and on a market value of $450 billion or whatever it may be, it doesn't amount to much, unfortunately. We'll still try and do it if we can.
Yeah.
Hey, Warren, I want to ask this question that came in because I think some people may have had a misinterpretation about something you said a few minutes ago. This is the benefit of being able to get these questions real time. But a few moments ago, you were talking about the people at the company who will be allocating capital after you and Charlie are no longer doing it. And you mentioned that you've got Todd, Ted, and Greg all doing that. But I've gotten a few questions that read similar to this. This one's from Edward Papula in New York City, who says, "Dear Warren, I noticed you didn't mention Ajit Jain when you reeled off your list of future management. Is he out of the picture?"
Well, Ajit is not in the capital allocation business. He is the best. Well, he's got one of the best minds in the world. I mean, I wrote his father after he worked for us for a few years. I wrote him again the other day, but 20 years ago I wrote him and I said, if you've got another son like this, send him over from India because we'll own the world. Then, no, Ajit is one of a kind. Anybody will tell you that's had any contact with him, and particularly anybody in the insurance business where they know him well, he is absolutely one of a kind. But his job is not capital allocation, it's evaluating insurance risks, and that is he possesses a rare talent, and he has a huge capital backing to do it. So he's an incredible asset. But Greg and Todd and Ted have been in the asset allocation business in a big way for a long time. That's their game, and Ajit's game is insurance. So that's why I mentioned those three. And incidentally, while Charlie and I are around, we kind of like capital allocation ourselves. So we're not going any place voluntarily, but we probably will go someplace involuntarily before that long. Charlie's in good health, incidentally. I'm in good health.
Greg, let me ask you one of these capital allocation questions. This one comes from Matt Leibel, and he says, Berkshire directed 46% of capital expenditure in 2019 to Berkshire Hathaway Energy. Can you walk us through with round numbers how you think differences in CapEx spending versus economic depreciation versus GAAP depreciation, and help explain the time frame over which we should recognize the contracted return on equity from these large investments as we as shareholders are making in Berkshire Hathaway Energy?
Right. So when we look at Berkshire Hathaway Energy and their capital programs, we try to really look at it as it was highlighted, really in a couple different packages. One, what does it actually require to maintain the existing assets for the next 10, 20, 30 years? i.e., it's not incremental, it's effectively maintaining the asset, the reflection of depreciation. And our goal is always to clearly understand across our businesses, do we have businesses that require more than our depreciation or equal or less? And happy to say with the assets we have in place and how we've maintained the energy assets, we generally look at our depreciation as being more than adequate if we deploy it back into capital to maintain the asset. Now, the unique thing in the lion's share of our energy businesses that are regulated, and that exceeds 85% of them, 83% of them, we still earn on that capital we deploy back into that business. So it's not a traditional model where you're putting it in, but you're effectively putting it in to maintain your existing earnings stream. So it's not drastically different, but we do earn on that capital. But what we do spend a lot of time, and that's what, when Warren and I think about the substantial amounts of opportunities, that's incremental capital that is truly needed within new opportunities. So it's to build incremental wind, incremental transmission that services the wind or other types of renewable solar. That's all incremental to the business and drives incremental both growth in the business. It does require capital, but it does drive growth within the energy business. So there's really the two buckets. I think we would use a number a little bit lower than the depreciation. We're comfortable the business can be maintained at that level, and as we deploy amounts above that, we really do view that as, quote, incremental or growth CapEx.
Yeah, we have what 40 billion or something. What do we have in sort of kind of in the works?
Oh yeah. So we have basically, as Warren's highlighting, 40 billion in the works of capital. That's over the next effectively 9 years, 10-year period. Approximately half of that we would view as maintaining our assets. A little more than half of it's truly incremental, and those are known projects we're going to move forward with. And I would be happy to report we probably have another 30 billion that aren't far off of becoming real opportunities in that business. Now, as Warren said, that takes a lot of time. It's a lot of work. The transmission projects, for example, we're finishing in 2020. Were initiated in 2008 when we bought Pacific Corp. I remember working on that transmission plan, putting it together, thinking 6 to 8 years from now we'll have them in operation. 12 years later, and over that period of time we earn on that capital. We have invested, and then when it comes into service, we earn on the whole amount. So we're very pleased with the opportunity, but we plant a lot of seeds, put it that way.
Yeah, and these are not. It's not like they're super high return thing, but they're decent returns and over time, and we're almost uniquely situated to deploy the capital as opposed. I mean, you could have government entities do it too, but in terms of a private enterprise, and they take a long time. They earn decent returns. I've always said about the energy business, it's not a way to get real rich, but it's a way to stay real rich. And we will deploy a lot of money at decent returns, not super returns. And you shouldn't earn super returns on that sort of thing. I mean, it does. You are getting rights to do certain things that governmental authorities are authorizing, and they should protect consumers, but they also should protect people that put up the capital. And it's worked now for 20 years, and it's got a long runway ahead.
All right, this next question comes from Jason in New Jersey. As both a Berkshire and Occidental shareholder, I was encouraged to see your investment in the company, but with passing weeks, it became evident that your investment facilitated Occidental management's ability to avoid a shareholder vote on the Anadarko acquisition, a very shareholder-unfriendly outcome. This deal proved to be irresponsible and expensive from an Oxy perspective, and ultimately very value-destructive for Oxy shareholders. In my view, it also permanently hurt Berkshire's reputation in the marketplace. Please comment on this unfortunate outcome and tell me why Oxy shareholders and other market observers shouldn't feel this way.
Well, yeah, we said right from the beginning, although we didn't certainly expect the degree to of what's happened. We said essentially when you buy into an a huge oil production company, how it works out is going to depend on the price of oil to a great extent. It's not going to be your geological home runs or super mistakes or anything like that. It is a investment that depends on the price of oil. And when oil goes to minus $37, it's happened the other day for I guess it was the May contract. That's off the chart, and if you own oil, you should only own oil if you expect these prices to go up significantly. I don't know whether they'll go up significantly or not. We're in the transaction. Our commitment was made on a Sunday when the management of Anadarko favored Chevron. And Chevron had a breakup fee of $1 billion, and Occidental people have been working on it for several years, and it was attractive at oil prices that then prevailed. And it doesn't work, obviously. It doesn't work at $20 a barrel. Certainly doesn't work at minus $37 a barrel, but it doesn't work at $20 a barrel. And everything the oil companies have been doing, whether it's Exxon or Occidental or anybody else, it doesn't work at these oil prices. That's why oil production is going to go down a lot in the next few years, because it does not pay to drill. Now, that's happened at other times in the past, but the situation is, you don't know where you're going to store the incremental barrel of oil, and oil demand is down dramatically, and for a while the Russians and the Saudis were trying to outdo each other in how much oil they could produce. And when you've got too much in storage, it doesn't work its way off that very fast. Now, you will have production of oil go down in the United States significantly. It does not pay to drill in all kinds of formations that it paid before, and it doesn't pay to have paid the price that oil was trading at in the ground a year or two ago. And to that extent, if you're an Oxy shareholder, or any shareholder in any oil producing company, you join me in having made a mistake so far in terms of where oil prices went, and who knows where they go in the future.
Let me follow up with this one then. This one comes in from Manish Bal, who says, is there a risk of permanent loss of capital in the oil equity investments?
Well, there certainly is. There's no question. If oil stays at these prices, there's going to be a lot of money, a whole lot of money, and it'll extend to bank loans, and it'll affect the banking industry to some degree. Not it doesn't destroy them or anything, but there's a lot of money that's been invested that was not invested based on a $17 or $20 or $25 price for WTI, West Texas Intermediate oil. And but you can do the same thing in copper. You can do the same thing in some of the things we manufacture. I mean, but with commodities, it's particularly dramatic. And farmers have been getting lousy prices, but to some extent, the government subsidizes them. I'm all for it, actually. But if you're an oil producer, you take your chances on future prices, unless you want to sell a lot of futures forward. Oxy actually did sell 300,000 barrels a day of puts, in effect, that or they bought puts, and sold calls, in effect, to match it, and they were protected at $10 for a layer of $10 a barrel on 300,000 barrels a day. But you're really buying, when you buy oil, you're betting on oil prices over time and over a long time. And oil prices, there's risk. And the risk is being realized by oil producers as we speak. There will be, if these prices prevail, there will be a lot of bad loans and energy loans or bad debts in energy loans. And if there are bad debts in energy loans, you can imagine what happens to the equity holders. So yes, there's risk.
All right, this question comes from Bob Coleman. He says, Warren, could you bring us up to date with the status of your equity put contracts? Sourcing the 2019 annual report found on page 60, it appears at 2019 year-end, the fair value liability was just under $1 billion. And if the indexes declined 30%, the liability obligations ballooned to $2.7 billion. So if the indexes are down 60%, would Berkshire's obligation be close to $5.5 billion? Does that math seem reasonable? And are there any loose ends or open exposures associated with
we between 2004, I think, and 2006, I think we wrote 48, maybe 50 contracts, something like that. The shortest was 15 years. The longest was 20 years. And we received as I remember, roughly $4.8 billion, which we were free to do with what we wanted. And we agreed to pay based on where one or more of four indices were selling for at the time of expiration. They were so-called European-style puts, where they're only payable based on one date. And we did not have, with a small exception, we did not have to put up collateral, which was part of the deal. And we've had that $4.8 billion. We probably had an original nominal value of something over $30 billion, maybe $35 billion. That's if everything went to zero. I mean, if Dow Jones went to zero, the FTSE went to zero, and the Nikkei and so on. A number of those have run off. So we now have about $14 billion nominal. We have something less than half left. We haven't paid out anything significant. We bought back a few of them. If everything went to zero, we would owe $14 billion. If everything were to sell at the same price it was selling for on March 31st, I think the number is I think it's somewhat less than we carry as a liability on the balance sheet, which is $2 and a fraction billion. So far, so good. I mean, we've had the use of a lot of money, and the outstanding potential of them is if the market went up a lot, we wouldn't have to pay anything, and if it goes down some more, we have to pay more than a couple of billion, but we've got the liability set up for that. But so far, so good on that, and it is not anything that causes us any problem. They come due, the final one I think comes due sometime in 2023. I think there's, I think maybe 20 or 25% of them come due late this year, and so there's nothing that the questioner doesn't really understand about them. I can tell by the question, and there's no surprises there. There's no way that some liability could double up on us except relating to where those indices close at the expiration of a group of different puts, which, like I say, have been more than cut in half. And we've done very well on it. Key to that.
Warren, you mentioned a few minutes ago that you...
Well, I was just going to say,
go
key
ahead.
to
Go
that
ahead, Warren.
was, with just a couple of tiny exceptions, we did not agree to put up collateral. We never would have gotten ourselves in that position. And that was when we made the deals. We just would not get ourselves in that position, and we never will. Where on a given date we could have some tremendous obligation that would come due that we weren't counting on having come due. I'm done then, Becky. Yeah.
Okay. Okay, thanks. So you mentioned a few minutes ago that you're very concerned about Berkshire's long-term health, too. This question came in from Drew Estes in Atlanta, Georgia, who says, there's already speculation of a post-Buffett breakup of Berkshire, and given the sway carried by modern activists, the speculation should be taken seriously. Many long-term owners see the folly in this view. A $25 billion ancillary earnings stream provides a lot of flexibility when investing insurance float. On our and your estate's behalf, could you more forcefully make the case of maintaining Berkshire's current architecture? If you don't, that responsibility will fall on an unknown set of shoulders with far less credibility.
Well, if you were to sell Berkshire's various subsidiaries, you would incur a very significant amount of tax at the corporate level before anything was distributed to the shareholders. You can spin off a given one or something of the sort, but the ability to break up a diverse company without tax implications, there was something called the general utilities doctrine that prevailed in various ways up until 1986. And a lot of people seem to comment based on the fact that that didn't happen in 1986. And there's imaginative ways where people try to avoid taxes and can do it in some cases. On certain types of transactions, if you were to break up Berkshire, that would be one factor. But the interaction of being able to move capital around in terms of being able to do things in insurance that we couldn't do unless there were the backup earnings and capital employed in the other entities, there's enormous advantages in capital deployment within the place. So there is not a big discount to break up value embodied in Berkshire's price. And the situation actually is that although all my Berkshire shares, every share, will be given to charities pursuant to a plan I developed back 14 years ago and followed ever since, and will continue following this July. I'll be giving away $3 billion or so worth of the stock. But it still involves a big voting percentage that, including other people that still remain in the picture, aside even from the Buffett family, it isn't going to happen. Now, I will tell you, everybody in the world will come around and propose something and say it's wonderful for shareholders. And by the way, it involves huge fees. I mean, you do not get impartial advice from Wall Street when there's enormous amount of fees possible from one action and no fees applicable from another action. But you can be sure I've thought about it, and I would say that you can count on Berkshire's present posture being continued for a long time. I can't tell you what's going to happen 100 years from now, and I can't tell you exactly what would happen, for example, if certain ideas in terms of wealth taxes changed or taxes on foundations change. I mean, but my plan has been thought out and in place for a long time, and it not only ensures that the money that's been made off Berkshire, all of it ends up going to various philanthropies staggered over time, but it also it will keep the wolves away. Greg, do you have any thoughts on that?
Well, I think the comment on the capital allocation is critical, that we have the ability to move the capital amongst be it the operating businesses or up to the insurance or down, with really no consequences to our shareholders. That's the value driver of the unique structure of Berkshire, and it creates immense value. So that's all I would add, or second, I guess.
All right, this question comes from Rob Grandish in Washington, D.C. He says, interest rates are negative in much of Europe, also in Japan. Warren has written many times that the value of Berkshire's insurance companies derive from the fact that policyholders pay up front, creating insurance float, on which Berkshire gets to earn interest. If interest rates are negative, then collecting money up front will be costly rather than profitable. If interest rates are negative, then the insurance float is no longer a benefit but a liability. Can you please discuss how Berkshire's insurance companies would respond if interest rates became negative in the United States?
Well, if they were going to be negative for a long time, you better own equities, or you better own something other than debt. I mean, it's remarkable what's happened in the last 10 years. I've been wrong in thinking that you could really have the developments you've had without inflation taking hold. But we have 120 odd billion. Well, we have some almost very high percentage in Treasury bills, some and some just in cash. But those Treasury bills are paying us virtually nothing now. They're a terrible investment over time, but they are the one thing that when opportunity arises, it will arise at a time, and maybe the only thing you can look to pay for those opportunities is the Treasury bills you have. I mean, the rest of the world may have stopped. And we also need them to be sure that we can pay the liabilities we have in terms of policyholders over time, and we take that very seriously. So if the world turns into a world where you can issue more and more money and have negative interest rates over time. I'd have to see it to believe it, but I've seen a little bit of it. I've been surprised, so I've been wrong so far. I do not think that. I don't see how you can create. I would say this: if you can have negative interest rates and pour out money and incur more and more debt relative to productive capacity, you'd think the world would have discovered it in the first couple thousand years rather than just coming on it now. But we will see. It's one of the it's probably the most interesting question I've ever seen in economics. Is can you keep doing what we're doing now? And we've been able to do it. The world's been able to do it for now a dozen years or so. But we may be facing a period where we're testing that hypothesis that you can continue it with a lot more force than we've tested it before. Greg, do you have any thoughts on that? I wish I knew the answer. Maybe you do.
No, I think as you articulated, I think it was in the annual report too. I mean, we don't know the answer, but as you said, some of the fundamentals right now are very interesting relative to having a negative interest rate. But I hate to say it, but I don't have anything to add.
Yeah, I'd love to be Secretary of the Treasury if I knew I could keep raising money at negative interest rates. That makes life pretty simple. We're doing things that we really don't know the ultimate outcome. I think in general they're the right things, but I don't think they're without consequences. And I think they could be kind of extreme consequences if pushed far enough. But there would be kind of extreme consequences if we didn't do it as well. So somebody has to balance those questions.
All right, this question comes from Adam Schwartz in Miami, Florida. He says Berkshire is the largest holding in his partnership, which also houses most of their net worth. He says Berkshire's invested in many capital-intensive businesses through the years, railroads as an example. How do you think about the inflationary or even deflationary risks for all of the capital-intensive businesses, and could this prove to be an existential problem for businesses? Kind of referencing what you were just talking about, that eventually the bill for the debts being issued comes due. Will it eventually come from all businesses through some combination of higher tax rates on corporations, increased wages for the lower middle class, et
Well,
cetera?
I certainly think that increased corporate taxes are a much higher probability than having lower corporate taxes. So I think that we got handed as a corporation a big chunk of what used to be the government's profits from our business a couple of years ago, and it would depend on, to some extent, which party is elected and whether they have control of both houses as well as the presidency, and who knows what else. But we could very easily have higher corporate income taxes and perhaps much higher corporate income taxes at some point. And in terms of capital-intensive businesses, they're just not as good if you can find an equally good business. I mean, in terms of operations that doesn't require capital. I mean, the Seas never required capital. It didn't grow, but it just doesn't. It didn't take money to expand it, and it delivered enormous sums to us. And because we own it within Berkshire, to redeploy it elsewhere didn't require a lot of tax expense, either at the corporate level or at the personal level. So you really want a business, and everybody wants a business, that doesn't take any capital to speak of and keeps growing and doesn't take more capital as it grows. Now, our utility business, our energy business requires more capital as it grows. Our railroad business, to some extent, requires more capital if it doesn't grow even. So capital-intensive businesses, by their nature, are not as good as something where people pay in advance, and you don't need the capital. I mean, if you look at where the top market value is in a $30 trillion market, if you take the top 4 or 5 companies that account for, maybe 4 trillion or so of that 30 trillion, basically they don't take much capital, and that's why they're worth a lot of money, because they make a lot of money and they don't require the money to any great extent in the business. We own some businesses like that, but it's certainly not the railroad, and it's not the energy business. They're good businesses. We love them, but if they didn't take any capital, they'd be unbelievable. They're good, but that's just what we've learned from 50 or 60 years of operating businesses, that if you can find a great business that doesn't require capital when it grows, you've really got something. And to a certain extent, because insurance uses the kind of assets we would like to own anyway, our insurance business doesn't really take capital. It requires having capital available, but we're able to invest that money largely in things we'd like to own anyway. So we're particularly well suited for the insurance business, and it's really been the most important factor in our growth over the years, although a lot of other things contribute. Greg, you were in the capital intensive business a long time. Tell us about it.
Well, I think there's no question, obviously, we'd prefer to be in a less capital intensive business, but there are unique opportunities there. And the one I would touch on when I think of inflation, or even potentially as we go through this crisis and maybe a prolonged one, or depending on how long it takes to recover. I mean, we are in a unique, when we're looking at energy or rail, we do have a certain amount of pricing power. And it's through our regulatory formulas or how our arrangements are with our customers. So if we then were to move into an inflationary period, it's not perfect protection, but those businesses generally can recover a significant portion of their costs, even in an inflationary environment, and still earn a reasonable return. They're not going to be great returns, as you highlighted, Warren, but they're still going to earn a reasonable return on their capital, even in an inflationary period. There may be some lag and some things like that, but they're still going to be very sound investments. So,
if there was 10-for-1 inflation, make it extreme, we'd be happy we own the railroad, very happy. Well, we'd be investing a lot of capital in it, but that business is, in my view, is a very, very solid business for many, 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 many decades to come. I said originally we bought it with a 100-year time horizon, and I've extended that. So it will earn more dollars if there's a lot of inflation. In real terms, who knows? But it would earn a lot more dollars, and a lot of the energy projects would. But it's better if we don't have inflation, and it's better if we don't have capital. if we can find the same sort of businesses that aren't as capital intensive. We've got capital. I mean, we're ideally positioned for capital intensive businesses that other people have trouble raising capital for, but they've still got to promise decent returns.
All right, this question comes from Charlie Wang. He's a shareholder in San Francisco. He says, given the unprecedented time of the economy and the debt level, could there be any risks and consequences of the U.S. government defaulting on its bonds?
No. If you print bonds in your own currency, what happens to the currency is it can be a question, but you don't default. And the United States has been smart enough, and people have trusted us enough to issue its debt in its own currency. And Argentina is now having a problem because the debt isn't in their own currency, and lots of countries have had that problem, and lots of countries will have that problem in the future. It is very painful to owe money in somebody else's currency, but if you listen, if I could issue a currency, Buffett bucks, and I had a printing press, and I could borrow money, and I could borrow money in that, I would never default. So what you end up getting in terms of purchasing power can be in doubt. But in terms of the U.S. government, when Standard & Poor's downgraded the United States government, I think it was Standard & Poor's some years back, that to me did not make sense. I mean, in the end, how you can regard any corporation as stronger than a person who can print the money to pay you, I just don't understand. So don't worry about the government defaulting. I think it's kind of crazy, incidentally. This should be said. To have these limits on the debt and all of that sort of thing, and then stop the government arguing about whether it's going to increase the limits. We're going to increase the limits on the debt. The debt isn't going to be paid. It's going to be refunded. And anybody that thinks they're going to bring down the national debt, I mean, there's been brief periods, and I think it's in the late 90s or thereabouts, when the debt's come down a little bit. The country's going to print more debt. The country's going to grow in terms of its debt-paying capacity. But the trick is to keep borrowing in your own currency.
Emphasis on the trick. This question comes from David Cass. He is a clinical professor of finance at the University of Maryland, and he says, Berkshire has invested in many companies with stock buyback programs. Recently, there's been a backlash against buybacks. What are your views on this subject?
Well, it's very politically correct to be against buybacks now. And they're going to incorporate it in the loan program. I mean, there's a lot of crazy things said on buybacks. Buybacks are so simple. I mean, it's a way of distributing cash to shareholders. And let's just say that you and I and Greg, the three of us, decide to buy an auto dealership or a McDonald's franchise or something, and we each put $1 million in, or whatever the number may be, and we get along with each other, and the business grows and all of that, and one of us really wants to spend our share of the earnings, and the other two want to leave the money in the business to grow. Now, if the three of us did that, and we're the only shareholders, we would not establish a 100% dividend payout for everybody, and we wouldn't freeze the one that wanted to get out either. The logical thing to do is to buy a portion, whatever that person wants to spend annually from the earnings, buy a portion of their stock, and the other two find their interest in the company goes up, and the third person still has a little more of an interest by what they leave in, but they also can take some money out of the business. You're taking money out of the business in either case, and one you call dividends, and you send it to everybody whether they want it or not. And with buybacks, you give it to the ones who want the money. And I have been following a policy of giving away stock now since 2006, and I'll give away a lot of stock, but the people, the philanthropies that receive it, the gifts have to spend the money very promptly within, on a current basis, more or less. So they are getting $3 billion worth of stock or whatever it may be, and I'm in effect reducing my interest in Berkshire, but Berkshire's still retaining more capital than I'm giving away. So I have more dollars invested, but my interest goes down. And the people that need the cash to carry out the philanthropic efforts, they cash out the stock. And I don't force my sister or whoever it may be to take a bunch of money she doesn't want. She wants it reinvested, all of it reinvested in the business. And people that don't want to can sell some of their stock. And the company ends up in the same position. We've distributed some of the capital that we don't need for growth. Now, whether the company should buy it depends on a couple of things. One is they ought to retain the money they need for intelligent growth prospects. That's fine. And secondly, and this is a point that's never mentioned, they should be buying it back below what they think it's worth. Now, they'll make mistakes in that, but you make mistakes in a lot of business decisions. But that should be the guiding principle. And to my knowledge, J.P. Morgan, Jamie Dimon said it once, and we've said it various times. We retain. We will repurchase shares when it's to the advantage of the continuing shareholder to have us do so. But you read about all these buyback programs that we're going to spend $5 billion buying it back or $10 billion. Well, that's like saying I'm going to go out and buy some business this year for $5 billion without knowing what you're going to get for the money. It should be price sensitive, obviously. It should be needs sensitive, obviously. But when the conditions are right, it should also be obvious to repurchase shares, and there shouldn't be the slightest taint to it any more than there is to dividends. And people that have now sort of taken up the cries about how terrible it was that companies bought back stock. Well, you can say it was terrible for them to pay dividends too, then they'd have more money now. But they were doing what was intelligent at the time, and I hope they continue to do what's intelligent as they go forth. Greg?
No, the only thing I know you've commented on in the past, Warren, is that I think the one thing we are seeing, and obviously we're supportive of buybacks, but there are companies that used probably their financial engineering was just a little
extreme
and too cute, that effectively you're using every ounce of your balance sheet to buy back stock at a time where you're really creating no cushion for your business for any type of event or bump in the road. And we're going to see that, and I think that's a very unfortunate outcome of them, and hence you get some of the backlash. But there's still companies, as you highlighted, many that do it right.
Yeah. No, if they're buying it back because it's fashionable, because they really do like the idea. There's nothing wrong with taking an action that increases the value of the remaining shares. But if they're doing it and incidentally, I've been witness to some programs where it really is stupid. But I don't think it's immoral. I just think it's stupid, basically. And on the other hand, we favor companies that take care of all their requirements for growth, and as Greg says, maintain sound balance sheets and all of that. Leave a margin of error for things that you can get surprised with. And if they find their stock selling below what the business is intrinsically worth, I think that they're making a big mistake if they don't buy in their stock. And it's going to be a political football. And like I say, that when it becomes politically correct to do something in this country, if you're a politician, the best thing to do is get on board. But Berkshire is going to do what it thinks makes sense for its shareholders. And we like investing in companies that think that way too. And not all companies obviously do.
All right, here's a question from Lou Bogart in Boca Raton, Florida. He says, I'm a longtime shareholder with a concern as I head into retirement. I understand the theory that splitting shares does nothing for the value of shares. However, with the extremely high price on A shares, when I wish to draw down some money on my portfolio in retirement, I'm facing a large tax hit. Say the average price has been about $300,000 this year, and I'm sitting on a $200,000 capital gains liability for each share. If I need $60,000 in additional cash during my retirement, I need to sell a full share and get hit with $200,000 tax liability. If you would split the stock 10 for 1, I could sell two $30,000 shares and keep my tax liability at a more manageable $40,000. I could also maintain more of my investment in Berkshire. He said, have you thought about this? In retrospect, I should have bought B shares, but didn't think of that at the time.
You can convert A to B shares, which is exactly what takes place when I give away the money in July to the 5 foundations. I actually convert it immediately before the gift. I mean, and so they get B shares. And the truth is the B shares are very useful to people that want to either give away a small portion of what they have or spend it or whatever it may be. So you can convert the A to B shares, which is exactly what I've been doing now for 14 years as I give it away, and solve that problem. And we split the B shares, as I remember it, at one point, just to make it even more manageable so that people could deal with smaller denominations. The B shares, the A shares have a different voting power, but we passed some resolution some time ago, I think, and it certainly would be the case in any event. We're never going to give the A shares an advantage over the B. They used to have an advantage in a shareholder designated contribution program that we had, and we put that in there when we started, but that goes way back in time, and that doesn't exist anymore. So that the B and the A are going to get treated exactly the same over time. It's true the A have more votes, but and they sell very close to parity all the time. So I would say that if you want to do anything in terms of raising cash and you've got a lot of A shares, you take 1 or 2 shares of A, and plenty of people I know have done this, and just cash it in, turn it into B, and give yourself whatever amount of cash you want to get.
This is one that comes from Thomas Lin in Taiwan. He says, Warren once said that banking is a good business if you don't do dumb things on the asset side. Given that the pandemic might put a lot of pressure on the loans, dumb things that got done in the past few years are likely to explode. Through reading annual reports, 10-Qs, and other public information, what clues are you looking for to decide whether a bank is run by a true banker who avoids doing dumb things?
That's a very good question, but I would say that the one thing that made Chairman Powell's job a little easier this time than it was in 2008-9 is that the banks are in far better shape. So in terms of thinking about what was good for the economy, he wasn't at the same time worrying about what he was going to do with Bank A or Bank B to merge them with somebody else or added strains on the system or anything. I mean, the banks were very involved with the problem in 2008 and 9. They had done some things they shouldn't have done in some of them, and they were certainly in far different financial condition now. So that the banking system is not the problem in this particular show. I mean, the government we decided as a people to shut down part of the economy in a big way, and it was not the fault of anyone that it happened. Things do happen in this world. Earthquakes happen. Huge hurricanes happen. This was something different, but the banks. The banks need regulation. I mean, they benefit from the FDIC, but part of having the government standing behind your deposits is to behave well, and I think that the banks should behave very well, and I think they're in very good shape. I mean, that's why the FDIC has built up $100 billion that I've talked about. I mean, they've assessed the banks in recent years at accelerated amounts in certain periods, and they even differentiated against the big banks. So they built up great reserves there, and they built their own balance sheets, and they are not presently part of Chairman Powell's problem, whereas they were very much part of Chairman Bernanke's problem back in 2008 and 9. How you spot the people that are doing the dumb things is not easy because, well, sometimes it's easy, but I don't see a lot that bothers me. But banks are, in the end, institutions that operate with significant amounts of other people's money, and if problems become severe enough in an economy, even strong banks can be under a lot of stress, and we'll be very glad we've got the Federal Reserve System standing behind them. I don't see special problems in the banking industry now. I could think of possibilities, and Jamie Dimon referred to this a little bit in the J.P. Morgan report. You can dream of scenarios that puts a lot of strain on banks, and they're not totally impossible, and that's why we have a Fed. And I think overall the banking system is not going to be the problem. but I wouldn't say that with 100% certainty, because there are certain possibilities that exist in this world where banks could have problems. They're going to have problems with energy loans. They're going to have problems. They're going to have extra problems with consumer credit. They're going to have, they're in, but they know it, and they're well reserved. Well, they're well capitalized for it. They were reserve building in the first quarter, and they may need to build more reserves, but they are not a primary worry of mine at all. We own a lot of banks, or we own a lot of bank stocks. Greg, do you have any thoughts on it?
No, I really, you touched on it earlier too, just in general, which is we don't know how long this pandemic will go. We don't know if there's going to be a second event, which are just risks that are really unknown at this time, and the banks will have to continue to manage through that as the businesses do. But you've already highlighted that, obviously.
Yeah. Becky?
All right, this question, I was looking for one of these because I got several questions that came in similar to this. I was looking for one of these a moment ago. This one's from Andrew Wenke. He says, can you ask Warren why he didn't repurchase Berkshire shares in March when they dropped to a price that was 30% lower than the price that he had repurchased shares for in January and February?
Yeah, it was very, very, very short period where they were 30% less. But I don't think Berkshire shares relative to present value are at a significantly different discount than they were when we were paying somewhat higher prices. I mean, it's like Keynes said, or whoever it was, if the facts change, I change my mind. What do you do, sir? We always think about it, but I don't feel that it's far more compelling to buy Berkshire shares now than I would have felt 3 months or 6 months or 9 months ago. It's always a possibility, and we'll see what happens. Greg, you think about repurchasing shares? I mean, generally.
No, I think our approach, Warren's the right approach. I mean, you're always, I can't really add anything other than the approach is the right approach. We approach it when we see it's the right thing for our shareholders to be repurchasing, and that doesn't mean we're repurchasing all the time or the view doesn't change.
Well, there could be a price relative to value at the time, not relative to what it was worth a year ago. I mean, the value of certain things have decreased. Our airline position was a mistake. Berkshire is worth less today because I took that position than if I hadn't. And there are other decisions like that. And they're not, it is not more compelling to buy the shares now than it was when we were buying them. It's not less compelling. I mean, it's a wash, but we didn't do anything. The price has not gotten to a level, or not been at a level where it really feels way better to us than other things, including the option value of money, to step up in a big way.
This question comes from 3 investors in Israel, Lidar Zloof, Yossi Zloof, and Dan Gorfung. They want to know about the credit card industry. It says, how do you explain the rise in the average credit card interest rate in recent years compared to the federal funds rate? What are the forces that you think might keep it at or around current levels, and what are the forces that might drive it lower in the future?
Well, that is not a subject that I'm, obviously it affects American Express to some degree. It affects the banks we own, but interest rates on credit cards respond to competition, obviously, to loss potential, which obviously has gone up significantly in the last few months, although it's gone down perhaps from some other periods you can pick in the past. But I don't really have much I can bring to the party on that question. We are not in the, well, that isn't true. Our furniture companies A couple of them have their own credit card, although they do a lot of business on other people's credit cards. My general advice to people, I mean, we have an interest in credit cards, but people, I think people should avoid using credit cards as a piggy bank to be raided. I had a woman come to see me here not long ago, and she'd come on some money, and not very much, but it was a lot to her. And she's a friend of mine, and she said, "What should I do with it?" And I said, "Well, what do you owe on your credit card?" And she said, "Well, I owe X." And I said, "Well, what you should do," I don't know what interest rate she was paying, but I think, I think I asked her and she knew, and it was something like 18% or something. I said, "I don't know how to make 18%. I mean, if I owed any money at 18%, the first thing I do with any money I had would be to pay it off. It's going to be way better than any investment idea I've got." And that wasn't what she wanted to hear. And then later on in the conversation, she talked about her daughter, and her daughter had $1,000 or $2,000 or something, and she said, "Well, what should I do with?" And she named the girls money, and I said, "Have her lend it to you." And I mean, if you're willing to pay 18% or whatever, I mean, she's not going to find a better deal. I'll lend you money. It just doesn't make sense. You can't go through life, borrowing money at those rates and be better off. So I encourage everybody. It's contrary to my own or Berkshire's interests in certain cases, and the world is in love with credit cards. But I would suggest to anybody that the first thing they do in life is not only, they can get to something else later on, but don't be paying even 12% to anybody. I mean, it's pay that off, and if they're really a good credit and they don't want to do it, come and see me personally. I'll lend you the money at that rate. Greg, what do you tell your children?
No, same advice. Excellent advice. No, I have three that carefully use their credit card. More, I would say, for not the. Obviously, people use it a lot more as they go into the digital world and e-commerce world, but then the goal has to be to repay it. It doesn't mean you, because you have to use it for those type of transactions, you run up the balance. But there's an incremental risk there now.
It's a matter of convenience for some people.
Yeah.
But I would have trouble if I were paying 12% for money or whatever it might be. It would not be a good thing. You won't see Berkshire paying that. Beck,
Warren, this question's from Lindsay Schumacher. Did you have something you were saying?
We probably ought to wind this up maybe in 15 minutes. Can you select the best ones?
Okay, absolutely. Yeah, well, I've got a couple more questions for you. This one's from Lindsay Schumacher. She says, "Warren, what's your opinion regarding the payroll protection plan?"
Well, I don't want to get into politics generally, but I think that's a very good idea to take care of the people that are having terrible troubles taking care of themselves in a period like this. I mean, if the government and surrounding conditions and whatever it may be, if you're telling a lot of businesses essentially, quit doing business for a long time, and it's one thing to tell me, but to tell somebody that's living from paycheck to paycheck that way, I'm all for it. It must be hell to administer. I mean, any huge program. I don't want to. I'll never get into criticizing on how people do this or that, because I've had problems myself in running a few big things. It just isn't that easy to inaugurate incredibly large problem. There's going to be a certain amount of fraud. There's going to be everything doesn't go perfectly, but I am 100% for taking care of the people that really get hurt by something that they've got nothing to do with, and where it's, who knows how long it lasts. You've got millions and millions of people that are worrying about something that they weren't worried about a few months ago, and they didn't do anything. They showed up for work on time, and they pleased the people they dealt with, and whatever it may have been. And now they don't have a job, or they've been furloughed or whatever. So I'm totally for the basic idea, and I think it's very difficult. You can't carry it out perfectly. You do your best, and you do it promptly. And I give I give real credit, to both Congress for acting promptly on what the problem is. They've sort of caught on from what they learned in 2008 and 9, I think. And I give credit to trying to do what I think is very much the right thing, and I don't sit around and think about how I could do it better. Greg?
No, I agree with the comments.
Warren, this question comes from Bill Murray, the actor, who's also a shareholder in Berkshire. He says this pandemic will graduate a new class of war veterans: healthcare, food supply, deliveries, community services. So many owe so much to these few. How might this great country take our turn and care for all of them?
Well, we won't be able to pay, actually. It's like people that landed in Normandy or something. I mean, the poor, the disadvantaged, they suffer. There's an unimaginable suffering, and at the same time, they're doing all these things that they're working 24-hour days, and we don't even know their names. So we ought to do. If we go overboard on something, we ought to do things that can help those people. And this country, I've said it a lot of times before, but the history of it, I mean, we are a rich, rich, rich country. And the people that are doing the kind of work that Bill talks about, they're contributing a whole lot more than some of the people that came out of the right womb, or got lucky and things, or know how to arbitrage bonds or whatever it may be. And I'm, in a large part, I'm one of those guys. So you really try to create a society that, under normal conditions, with more than $60,000 of GDP per capita, that anybody that works 40 hours a week can have a decent life without a second job and with a couple of kids, and have, they can't live like kings. I don't mean that, but that nobody should be left behind. It's like a rich family. You find rich families, and if they have 5 heirs or 6 heirs, they try and pick maybe the most able one to run the business, but they don't forget about the kid that actually may be a better citizen in some ways even than the one that does the best at business, but it just doesn't happen to have market value skills. So I do not think that a very rich company ought to totally abide by what the market dishes out, in 18th century style or something of the sort. So I welcome ideas that go in that direction. We've gone in that direction. We did come up with Social Security in the 30s. We've made some progress, but we ought to. I mean, we have become very, very, very rich as a country, and things have improved for the bottom 20%. I mean, you can see various statistics on that, but I'd rather be in the bottom 20% now than be in the bottom 20% 100 years ago or 50 years ago. But but it's what's really improved is the top 1%. And I hope we as a country move in a direction where people Bill's talking about get treated better, and it isn't going to hurt. It isn't going to hurt the country's growth, and it's overdue. But a lot of things are overdue. I will still say we're a better society than we were 100 years ago. But you would think with our prosperity we would hold ourselves to even higher standards of taking care of our fellow man, particularly when you see a situation like you've got today, where it's the people whose names you don't know that are watching the people come in and watching the bodies go out. Greg?
Yeah, the only other group that I would highlight, and I think it'll be very interesting to see how it plays out, is with the number of homeschooling and the children that are home. I think there's we've always had so much respect for our teachers, but we all talk about how we don't take care of them. And it is remarkable to hear how many people comment that clearly we don't recognize. Or, I have a little 8-year-old Beckett at home, and plenty of challenges for mom, but all of a sudden you respect the institution, the school, the teachers, and everything around it. So and then when I think of our companies and the delivery employees we have, it's absolutely amazing what they're doing, and they're truly on the front line. That's where we have our challenges around keeping them health and safety. And then you go all the way to the rail. The best videos you see out of our companies are when we have folks that are actively engaged in moving supplies, food, medical products, and they're so proud of it, and they recognize they're making a difference. So a lot of it is we just owe them a great thanks. And Warren, you touched on it. We can some way, maybe hopefully longer term, compensate them, but there's a great deal of thanks, and I probably just think an immense amount new appreciation for a variety of folks.
We're going the right direction overall in the country, but it's been awfully slow.
Yeah.
Gentlemen, I'll make this the last question. It comes from Phil King. He says, many people in the press and politics are questioning the validity of capitalism. What can you say to them that might prompt them to take a look at capitalism more favorably?
Well, the market system works wonders, and it's also brutal if left entirely to itself. And we wouldn't be the country we are if the market system hadn't been allowed to function. And to some extent, you can say that other countries around the world that have improved their way of life dramatically, to some extent, have copied us. So the market system is marvelous in many respects, but it needs government. And it is creative destruction, but for the ones who are destroyed, it can be a very brutal game, and for the people who work in the industries and all of that sort of thing. So I do not want to come up with anything different than capitalism, but I certainly do not want unfettered capitalism, and I don't think we'll move away from it, but I think we capitalists, I'm one of them, I think there's a lot of thought that should be given to what would happen if we all drew straws again for particular market-based skills. It's somewhere way back, somebody invented television. I don't know who it was, and then they invented cable, then they invented pay systems and all of that. And so a fellow that could bat .406 in 1941 was worth $20,000 a year, and now a marginal big leaguer, will make vastly greater sums because, in effect, the stadium size was increased from 30 or 40 or 50,000 people to the country. And the market system, capitalism, took over. And it's very uneven. And incidentally, I think that Ted Williams worth a whole lot more money than I've ever should make. But the market system can work toward a winner-takes-all type situation, and we don't want to discourage people from working hard and thinking hard. But that alone doesn't do it. There is a lot of randomness in the capitalist system, including inherited wealth, and I think we can keep the best parts of a market system and capitalism, and we can do a better job of making sure that everybody participates in the prosperity that produces. Greg?
Yeah. No, I think it's always keeping the best parts of it. And I even think if we look at the current environment we're in, i.e. in the pandemic, and we have to do it only when we can do it properly and reemerge. But in some ways, the best opportunity for people is when we're back working, clearly, and that the system's functioning again. But that's the obvious. And then there's, as Warren, you've highlighted, there's a lot of imperfections, but it's still it's definitely the best model out there that just needs some fine tuning. And
Becky, at the end, I would just,
Hey, Warren,
I would just say that, oh, sure, go
can
ahead.
Can I just
Sure.
slip in one more quick question?
Absolutely.
I forgot this one. Someone sent it in earlier. Thanks. Anderson Haxton wrote in. He said, Warren mentioned that Ben Graham is one of the 3 smartest people he's ever met. I'd like to ask him the names of the other 2.
Well, I may not be one of the smartest, but I'm smart enough not to name the other 2. I'd make 2 people happy, but I would. It isn't. Ben Graham is one of the 3 smartest people, and I've known some really smart people. Smartness is not necessarily. Does not necessarily equate to wisdom either. And Ben Graham, one of the things he said he liked to do every day was he wanted to do something creative, something generous, and something foolish. And he said he was pretty good at the latter. But he was pretty good. He was amazing, actually, at the creative. But it's interesting that IQ does not always translate into rationality and behavioral success or wisdom. And so I know some people that are extraordinarily wise that would not be in the top 3 on an IQ test. But if I wanted their judgment on some matter, even if I want to put them in a position of responsibility someplace, I might prefer them to we'll say one of the 3. That'll leave the other 2 feeling fine of the 3. Greg, do you have any thoughts on that?
Nope. I agree with the person you named.
Yeah. And Becky, I would just say again that we may have. I hope we don't, but we may get some unpleasant surprises. And we're dealing with a virus that spreads its wings in a certain way, in very unpredictable ways, and how Americans react to it. There's all kinds of possibilities, but I definitely come to the conclusion after weighing all that sort of stuff, never bet against America. So thanks.
Yeah.
Thank you. I appreciate your time tonight.
And we'll see you next year, and we'll fill this place. Okay.
Okay. Good night. Good night, everybody.
Night.
Well, that sure was something. Welcome back to Yahoo Finance's special coverage of the Berkshire Hathaway annual meeting. live from Omaha, Nebraska. You've been watching Warren Buffett speaking there for just about 4.5 hours. He was joined by Greg Abel answering questions there. When Buffett started today, it was really an extended opening statement full of slides, a history lesson, and his advice to never, ever bet against America. He said the American miracle, American magic has always prevailed. And then just in those closing remarks, you heard him again talking about that. So, of course, Greg Abel was there instead of Charlie Munger, who is usually right next to Buffett. Again, this all started at 4:45 Eastern time. So while there are a lot of things that were different this year, one thing that is the same is that Warren Buffett can go for hours. Lots of headlines out of this meeting. Berkshire has exited its stakes in 4 U.S. airlines. Warren Buffett saying that the world has changed for airlines. Berkshire posted a record $137 billion of cash at the end of March. They have the cash, but they aren't doing deals. He said we haven't seen anything attractive. So I want to go to Andy Serwer, one of the smartest people I know. Andy, on the floor there, you have been in the room where everything was going on. Tell us about what stood out to you.
Yeah, who are the 2 other smartest? I got to ask.
Later.
Yeah, there's Miles and Julia. Whitney Tilson, no doubt. You can see right behind me that Warren Buffett and Greg Abel are done. They finished. I mean, what amazing stamina, right? I mean, here's a guy who's 89 years old. He talked in excess of 4 hours. He's so passionate about all this stuff. But, there's so many different things going on. First of all, that soliloquy, that history lesson at the very beginning was, really unprecedented, really amazing. And then, of course, getting into the questions and people, I'm always really impressed, I'll be honest with you, with the depth of the questions by the Berkshire shareholders. I mean, but you've got, the world's best accounting and accountants and investments managers asking the questions. They're really, really striking. And the scene here, there were about, 12 people here, and just seeing all the social media coming in, we're this little place here with just a few people and, hundreds of thousands, millions of people from around the world watching and listening. And, it's kind of an amazing and different kind of feeling as far as that's concerned as well. And you see Warren and Greg are still up there, so they can't get away. Back to you guys.
They keep going. So I want to bring in Miles and Julia. We also have Whitney Tilson from Empire Financial. Miles, let's start with you. I just was really struck from the beginning with his big bullish bet on America. And then the news that he sold over $6 billion in stock in April. So how do you square all of that? What is his outlook for the situation that we're in right now with coronavirus and the economy?
Well, that's the thing is that whole windup, the 75 odd minutes, however exactly long it was, I think it sounds like a bullish bet, but it wasn't really a bullish bet on America, especially considering the way that Buffett has tended to discuss his view of the American tailwind, this idea that he's discussed for a number of years now. I mean, I thought he was cautious at best. And I mean, maybe we're just kind of parsing things a little bit, but at the same time, the guy's been in the public eye for 30, 40 years, and he's mostly said similar things. So all we really have to go on is a close reading, I guess, of Buffett. And my reading was, you can bet on America long-term, but you better be long-term. I mean, you better not be sitting here thinking this is going to turn around quickly. I think that's a pretty big shift in my view of how Buffett normally sees things. And so I think the tone was measured, cautious. Those are probably the best words we can use. And his actions, speak much louder than anything he said. He sells the airlines, as we're going to discuss. He doesn't buy back the shares, and his defense there was, it was fine. I mean, I understand what he's saying, but there's still a lot of questions about why isn't he aggressively buying back shares? And he's waiting. I mean, he doesn't feel the conviction, the need to do anything right now. And I think that's markedly different than the way that we've seen Buffett in the last couple of years. And I would just add, I think he's been watching Andrew Cuomo's press conferences and saw the slides and said, that's a great idea. I want to communicate that way, because the tone of his slides were very similar to the Cuomo. Maybe I'm just watching way too many Andrew Cuomo press conferences. What else are we going to do? But I saw the inspiration, I guess, from Cuomo to Warren in that respect.
Hat tip there to Cuomo. Julia, what do you think? Because I did go back and revisit.
Hey, Jen, I think I lost you for a second there.
Oh, go ahead, Julia.
Okay, yeah. So, well, I don't know what Jen asked me, but I'll give you my views. I agree with Miles. I kind of got the same sense that there was a little bit of, like he just said, just a little bit more measured, but does take the long view. And I got to say, I think this is the kind of shareholder meeting that we needed right now, given the situation that we're in. We're all in lockdown still pretty much. And to hear from Warren Buffett for that long was great. I think when you look at what makes him such a great leader is that he's got this candor about him, and he was answering some pretty tough questions, being very forthright about exiting the airline stocks, talking about this share buybacks. I was a little bit surprised that he has been both a critic and a supporter of buybacks in the past. And I think he does make a compelling point that it has become this political football. And then also, answering, I would love to hear Whitney Tilson's thoughts on this about the share repurchases or lack thereof of the Berkshire Hathaway share repurchases when they had the follow-on question there. And again, just going back to the audience that we were talking about, a massive audience out there, global, all around the world. Andy, you were making reference to that. And I love that Bill Murray asked a question right toward the end about just how can we kind of repay those who are on the front lines. I just love that question. And it was overall, I thought it was a fantastic shareholder meeting.
Yeah, I agree. Interesting stuff, Julia. The big headline, I guess, has to be the airlines and the fact that Buffett said that he sold all of his stakes out. Let's take a listen to how he described that.
Just to clarify on his question, he asked, did you sell your whole stake in all four of those
the
companies?
answer is yes. Yeah, when we sell something, we sell something, very often it's going to be our entire stake. I mean, we don't trim positions or that's just not the way we approach it any more than if we buy 100% of a business, we're going to sell it down to 90% or 80%. I mean, if we like a business, we're going to buy as much of it as we can and keep it as long as we can. But when we change our mind,
Right, the next
go
question.
ahead. I'm sorry.
No, go ahead. When you change your mind?
Well, when we change our mind, we don't take half measures or anything of the sort. So I was amazed at how, frankly, now we were selling them at far lower prices than we paid, but I was amazed at the volume. The airlines always trade in large volume relatively, but we have sold the entire positions.
All right, I want to bring in our guest, Whitney Tilson. And Whitney, what's your reaction to that airline sale and other thoughts you might have?
Yeah, well, specific to the airlines, I wasn't surprised at all. It was public information 2 weeks ago that he'd sold a bunch of Delta and Southwest. And like you said, when Buffett takes an action, he generally follows through on it. So the moment I saw that in the 10Q, the disclosure that they'd sold 6.1 billion of equities, I figured it was the rest of the airlines, and that turned out to be exactly right. So it's not big news to me. But the single biggest takeaway from the meeting for me was we just watched an 89-year-old man go for 4.5 hours straight. And I don't know about you guys, but I'm exhausted just trying to follow 4.5 hours and pay attention, because I'm worried that you might ask me a question about something they said in the meeting and I wasn't paying attention, right? So I had to pay attention for 4.5 hours. And so it's incredible that a guy at that age has that kind of mental stamina, just forget the physical stamina. So as a long-term Berkshire Hathaway shareholder, the thing you really have to worry about is Buffett's cognitive decline. And I didn't see any of it. I can't say he's getting better with age, but if you played a recording of the annual meeting from 5 years ago versus today, I could not tell you which was which. I'm not seeing any decline at all. So that's really important.
Yeah,
I think that's absolutely right. Go ahead, Julia.
Yeah, Whitney, as someone who's been watching, I guess this is now your 23rd annual meeting that you've been watching. What was kind of your read? We were talking early at the top of the show, Miles was at least as well. What was your read on his kind of sentiment? Were you sensing that he's bullish, or are you kind of getting some maybe bearish undertones there?
No, I mean, as I said before the meeting, I knew he was going to say we're bullish on America, et cetera, et cetera. But you got to watch what people do, not what they say. And he's been a net seller of equities to the tune of about $3.4 billion so far this year in a period of time when I thought anyway it was raining gold. So he clearly does not think it was raining gold. And I think the single most he was very cautious. That's the word Miles used. I agree with entirely. I would say very conservative. I'm not going to say bearish because it's not like he's dumping all his equities or looking to sell wholly owned businesses and all. So he's still long-term bullish, and I completely agree with him on that. But I do wish, I mean, he can't control the phone ringing, and maybe he was waiting for stocks to get cheaper out there, though honestly, with all the bank stocks that he loves so much, they were all down 40%, and he couldn't find a single bank stock to buy. And Berkshire stock itself fell more than 30%, and he pointed out that it wasn't a lot of volume, but he sometimes just does little things on principle. He couldn't have bought a little bit of stock below $250,000 a share. Even in the absence of volume, it certainly would have signaled that, hey, even if you do something in small scale that makes sense, it makes sense to do as much as you can. I mean, who knows how long it would have stayed down there, right? So he said, though, I'm going to quote, he said the reason he didn't is because it is, quote, not more compelling. His share price was not more compelling at current prices or at 250,000 a share than it was when he was repurchasing back in early March at 300,000 a share, according to the filings in the 10Q. So he's clearly saying that Berkshire Hathaway's intrinsic value has been impaired here, and he doesn't know by how much. But the other really interesting quote is when he said that, he said, including the option value of money. In other words, Berkshire Hathaway may well be cheaper today relative to intrinsic value than it was a couple months ago, but the value of cash has skyrocketed since this coronavirus crisis. So that makes me rethink, okay, maybe I'm okay with you not buying back as much stock as I would have liked to see, because having cash, you know the old saying, in the land of the blind, the one-eyed man is king. Well, when you have cash in a world that's going crazy, that cash becomes much more valuable. So,
Yeah.
That's the bet Buffett's making.
Whitney Tilson, thank you so much for sticking with us through, as you said, it was more than 4 hours. Impressive performance there. We really enjoy you joining us right now. We're going to be back after a short break with our final thoughts on Berkshire Hathaway's annual meeting. Welcome back to Yahoo Finance's coverage of the Berkshire Hathaway annual meeting. Andy Serwer is in Omaha. He was one of just a very few people that were there in the convention center while the meeting was going on. So Andy, we've covered some of the airline news here, which was a big deal. Your final thoughts on what stood out to you?
Well, let's face it. I mean, he was giving a pep talk to America. And, he kept saying over and over again, never bet against America. He was really trying to cheer this country up and trying to reiterate that through all this, we were going to persevere, survive, and ultimately thrive. And, to the extent that we needed it, thank you, Mr. Buffett. I think a lot of people out there maybe have taken some little bit of hope out of that conversation we had today. And Miles, what about you?
Yeah, well, Andy, to that point, I mean, it sort of echoes things that we've discussed on our programming, which is, are we trying to talk others up or talk ourselves up? I wonder how much of his commentary was that split. But, something, Andy, that you tweeted out during the meeting, I think is interesting because it applies to so many investors and also, of course, Warren Buffett, which is that the Fed acted so swiftly and with so much force. Some opportunities that he thought might come to him just did not. Now, I think we have a very long way to go in this crisis, but I think if you ran the 2008 playbook back, investors said, oh, I've got a few months here to be patient and to see what happens. But that happened in about 2 weeks, 3 weeks at most. And so I think Buffett has been pleasantly surprised, I would add, by the Fed's actions, but it's certainly hamstrung what he could do ever so slightly. All right, Julia LaRoche, what do you got?
Yeah, hey, Miles, I think that's an interesting point because if you remember earlier there, he said he would put Jay Powell up on a pedestal just like Paul Volcker, also gave a shout out to Paul Volcker's book. And then, Andy, to your point, I think you're right. I think in this moment in time, this is going to be a meeting that we are going to remember forever, just the way we covered it. You being there in Omaha, in the empty CHI Health Center arena. This is something that we'll talk about for many, many years to come. And it's this time where we need to hear that message of don't bet against America. I guess if I had to do a separate parting thought, Greg Abel, it was great to get to see Greg Abel in action on the stage, to hear his thoughts. I really appreciated his comments about share buybacks, about, how some folks aren't very prudent about it, that they're not thinking about, they're getting a little too cute, I guess, with the financial engineering and balance sheet and using every ounce of that. And I think there's going to be this bigger takeaway that you're going to have to be prepared for rainy, inevitable days that will come.
Yes, indeed. And as he said, the virus is going to determine our behavior. I think, we all know this is a very different year. Thank you all so much for joining us for our exclusive coverage of the Berkshire Hathaway annual meeting. You can go to our landing page, yahoofinance.com. We have all the highlights there. You can get all caught up. Again, thank you from all of us at Yahoo Finance. Stay safe and have a great weekend.
Warren Buffett needs little introduction. He's the godfather of modern-day investing. For nearly 50 years, Buffett has run Berkshire Hathaway, which owns over 60 companies like Geico and Dairy Queen, plus minority stakes in Apple, Coca-Cola, and many others. His $82.5 billion fortune makes him the third richest person in the world, and he's vowed to give nearly all of it away. The Oracle of Omaha is here to talk about what shaped his investment strategy and how to master today's market. I'm Andy Serwer. Welcome to a special edition of Influencers from Omaha, Nebraska. It's my pleasure to welcome Berkshire Hathaway CEO Warren Buffett. Warren, welcome.
Thanks for coming.
So let's start off and talk about the economy a little bit. And obviously, we've been on a good long run here.
A very long run.
And yet, does that surprise you? And what would be the signs that you would look for to see that things were winding down?
Well, I look at a lot of figures just in connection with our businesses. I like to get numbers, so I'm getting reports in weekly in some businesses. But that doesn't tell me what the economy is going to do 6 months from now or 3 months from now. It tells me what's going on now with our businesses, and it really doesn't make any difference in what I do today in terms of buying stocks or buying businesses. What those numbers tell me, they're interesting, but they're not guides to me. If we buy a business, we're going to hold it forever. So we're going to have good years, bad years, in between years, maybe a disastrous year some year, and we care a lot about the price. We do not care about the next 12 months.
But are you surprised at how long this economy has been expanding?
I've been surprised by all kinds of things in the last 10 years about the economy. I mean, I don't think there was any economist I've ever read that talked about negative interest rates for long periods of time. I mean, if you go back and read Keynes or you read Samuelson, you read any of them, they do not get into a negative rate environment. I think now there's still 11 trillion that's of government debt around the world that's at a negative rate. So we've never seen it before, and we've never seen, at least the conventional wisdom on a sustained period of long and growing deficits while the economy is getting better, extremely low interest rates, and really very little inflation. So something different is happening, but something different happens all the time. So, and that's one reason economic predictions just don't enter into our decisions. Charlie Munger, my partner, and I, in 54 years now, we've never made a decision based on an economic prediction. We make business predictions about what individual businesses will do over time, and we compare that to what we have to pay for them. But we have never said yes to something because we thought the economy was going to do well in the next year or 2 years, and we've never said no to anything because we were right in the middle of a panic, even if the price was right.
All right, so you don't pay much attention to the dismal scientists then, I guess.
Well, I pay none in the sense of as a guideline to doing anything. It's entertainment. I mean, it's like going to a variety show or something like that. But and I just don't know of any economist that actually has bought businesses successfully or done well in stocks. Paul Samuelson did. You may know he was a big shareholder of Berkshire, but it's, they make guesses, and there's so many variables. I mean, in the hard sciences, you know that, if an apple falls from a tree, that it isn't going to change over the centuries because of anything or political developments or 400 other variables that go in. But when you get into economics, there's so many variables, and the truth is, you've got to expect good times and bad times in business. And if you were to buy an auto dealership and you're, wherever you live locally, or a McDonald's franchise or anything like that, you wouldn't try and time the purchase. You'd try and make the right purchase at the right price, and you want to be sure you got a good business. But you wouldn't say, I'm going to buy it because growth this year is going to be 3% instead of 2.8% or something of the sort.
Fair enough. You have over $100 billion of cash.
Berkshire does that.
Berkshire. No, well, I don't even see how much you got. Maybe you do. Berkshire has over $100 billion in cash, and you say that you always want this company to be a fortress. So how much cash should an ordinary investor have on a percentage basis, do you think?
It depends on their personal situation. If you're working in something where you're living off your paycheck from week to week, you want to have a little cash around, and you certainly don't want to have a credit card that's maxed out or anything like that. But if your house is paid off, if you don't have big living expenses, you got a portfolio of decent, diversified businesses, you don't really need any cash.
So you can be more cash-free than Berkshire is?
Yeah, I've got responsibility. We've got insurance claims. We could have hurricanes that, would happen. all kinds of things where we might have to pay out billions of dollars. And I've got over 1 million people that own shares that are counting on me to run the place so we get through periods like that. But if I were retired, I had say $1 million portfolio of stocks that was paying me $30,000 a year in dividends or something of the sort, and my children were growing, the house was paid off and everything. But, I wouldn't worry too much about having a lot of cash around.
Let's talk a little bit about Apple. Everyone always wants to talk about Apple, right? It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? You know, people are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
Really?
No. I mean, if you buy a business, if you buy a farm, do you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm and you hold it for. I've got one farm that I bought in the 1980s, and my son runs it, but I've been there once. I mean, it doesn't grow faster if I go and stare at it. I can't cheer for it. More effort, or something like that. And I know there's going to be some years when prices are going to be good and some when the prices aren't going to be good. I know there's years when yields will be better than others. But I bought the farm, and if it just doesn't. I don't care about economic predictions on it or anything of the sort. I do care that over the years it's well tended to in terms of rotating crops, and I hope yields get better, which they generally have. In fact, that farm 100 years ago would have probably produced 30 bushels, maybe 35 bushels of corn per acre. And now in a good year, it'd be 200. I mean, we've really made progress in this country. That's one reason commodity prices, if you go back a couple hundred years, they've moved so little, is because we've just gotten better and better at whether it's cotton or whether it's corn or soybeans or all kinds of things. And you and I have benefited from that.
And so Apple is kind of like a farm.
Well, it's a long-term investment, and if you own the best auto dealership in town, the best brand, and you had somebody good running it, you wouldn't drop by every day and say, how many people have come in today, or I think interest rates are going up a little, maybe it'll slow down our sales or anything. No, you buy it knowing there's 365 days a year, and you're going to own it for 20 years, so that's 7,300 days, and things are going to be different from day to day and year to year. You shouldn't buy it if the day-to-day stuff is important.
Let's switch over to talk about buybacks, which is another hot topic these days. And you did a fair amount. If you look in the annual report, you can see that between December 13th and 24th, it looks like you guys bought back about $233 million worth of Berkshire, which was right near that particular stock market bottom. How did you know that? Or what was going through your mind?
If I knew it, I'd have bought a lot more than 200 million. No, that's not a big purchase for us, actually. And no, we will buy Berkshire when we have lots of excess cash. All the needs of the business are taken care of. We spent $14 billion on property, plant, and equipment last year, way more than depreciation. So we take care of the needs of the business. Then we have excess cash. And if we we'd love to do is find other businesses to buy. But if I think the stock, and my partner Charlie Munger think the stock is selling below intrinsic business value, we will buy in stock.
So it obviously was at that point.
Well, we thought so, yeah. But what's really intriguing is when it goes down a lot. I mean, when you're buying dollar bills for 60 or 70 cents, which periodically you get a chance to do in stocks, then assuming you've got the cash, you don't want to ever get so that some surprise could really take you out in some way. But if we've got excess cash, we'll buy it as fast as we can.
But at that point, it would be more like a 2009 rather than just December of this past year.
Yeah, exactly.
Right.
But it's, if you and I own a McDonald's franchise together and it's worth $1 million and you own 50% of it and you come to me and you say, I'll sell out for 400,000, I'll buy you out.
If you want to buy mine, I'd be wary of that, but for just that reason.
You should be, yeah. But if you want 600,000, I'll just say, come back tomorrow.
So just continuing about buybacks, Senator Schumer and Sanders want the government to weigh in to sort of legislate when companies can do buybacks. And then also there was a report recently about executives doing insider trading, it appears, around the times of buybacks. So are buybacks a kind of a problem?
Well, you'll have some people that misbehave in respect to any activity. I mean, it really wouldn't have much to do with buybacks. I think buybacks, the degree to which they've been part of nefarious activity, and I've observed them for a lot of years, are very close to zero. But that just may be that there aren't enough opportunities. But that article did not. I didn't follow the conclusion on it. I mean, you're distributing money to shareholders. Essentially, you can do it by dividends, and presumably American business should distribute money to its owners occasionally. And we do it through buybacks, or we've done some, and we don't do it through dividends. But most companies do it through having a dividend policy. And then if they have money beyond the needs of the business, then I think if their stock is underpriced, then it makes nothing but sense.
Should the government tell companies when to do it, or at least mandate conditions where they can?
Well, they do restrict you a little in terms of if you're some general rule of the SEC, if you're having some kind of, this isn't quite the right word, but manipulative activity or anything like that in the stock. But no, I don't think the government should decide your dividend policy. I don't even think they should direct your capital investments. They can make it enticing to make certain kinds of capital investments, which they do with renewable energy, for example. I mean, the government has interest in fostering certain developments in this country over time, and they do. There used to be a special oil depletion allowance, 50 years ago and so on. That was more politics than it was governmental policy, but certainly renewables are a prime example of that. But the idea of directing whether you are entitled to return cash to shareholders and the manner in which you do it, I don't think really makes a lot of sense.
The 2020 election is going to be upon us before we know it. And I know that you had some nice things to say about Mike Bloomberg, but it appears he is not going to be running now.
Yeah, it's hard to win with just a billionaire vote.
You have your vote and a few others. That's funny.
But I admire him enormously. I wish he had run. I want to be very clear on that.
President Trump was a business executive. So 2 questions. Is a business executive the right kind of person to be president? And what characteristics do you look for a president that you would support?
Well, I think a business executive can be the right person, but I don't think that because they're a business executive that you give them extra points. And number one, I want a president that wakes up every morning and realizes that the greatest threat to a country which has got all kinds of things going for it are weapons of mass destruction, and that we live in a world where people, organizations, and occasionally countries could have people that would like to wipe out a large percentage of the American people, or maybe other countries as well, and that you now have capabilities which I always thought until recently I classified as nuclear, chemical, and biological, but I think you have to add cyber now. If you have some evil genius someplace that for crazy reasons, just like happened with anthrax back, who knows what motivates somebody that starts sending anthrax out in letters. And if you have somebody that thinks that it'd be great to send a false alarm to the Russians and to the U.S. that the other side was launching or something of the sort. It's a very, very dangerous world. It's a wonderful world, but it has dangers now that started in August of 1945, and when Einstein said, this changes everything in the world except how men think. And so I want a president that has that same filter, that all of these other things are important, but protecting the country and reducing the chance of successful use of weapons of mass destruction against us is the number one job. And I think most of the presidents, I've talked to a couple of them about it over the years, and I really think that they do realize that they may get lost in the events of every day as they go along. And then beyond that, I want a president that has two objectives with the economy. One is to make sure that this marvelous goose we have keeps laying more golden eggs. And then I want a president that also feels that if GDP is $60,000 per capita in the United States, that nobody should get left behind. We've got a market system that works marvelously in turning out more goods and services, better ones, year after year. Done it all through my life.
Would you ever talk to a candidate and say, hey, what do you think about these three things?
Well, they'll tell me what I want to hear in most cases. So I want to hear what they tell people who disagree with them on the subject. I always like to ask a candidate, they usually finesse me some way or another, but I say, what are you for that the majority of your followers are against? You know, I know you really believe in that, you know, and that's really the test, but I'm not sure that, except under some kind of sodium pentothal or something, you're going to get a great answer to that question.
That's great, but that's the question you ask the presidential candidates or presidents that you would speak to.
If I really want to get, and that's why Bernie Sanders was so successful. I mean, 90% of the people who voted for Bernie Sanders had probably not heard of him 2 years earlier, but they felt they knew exactly what he would do. I mean, they felt he was authentic. And if you asked him, you know, what he was for that most people might be against, he would tell you, you know.
A few questions about Kraft Heinz. Was that a mistake?
Well, we'll find out over time, but we did pay too much, in my view, for Kraft. We didn't pay too much for Heinz. So when we started out, it was originally a non-public partnership between us, but we did pay too much, in my view, for Kraft. And there's not much you can do about things if you pay too much. Secondly, there's always been a struggle between the retailer and brands. I mean, if I've got a terribly weak brand and I want to get into Walmart, I'm not going to be able to do it. You know, I mean, I have to offer all kinds of crazy concessions, you know, and I want to be in Walmart if I have some sort of consumer packaged goods. The negotiation is way different if you have something essential versus non-essential. 10 years ago, Costco tried to get rid of Coca-Cola. Costco's got terrific loyalty among customers, and you know, and their own Kirkland brand is a $39 billion brand now, and it moves from category to category, and they only started in 1992. So they know brands, and but in the end, they put Coca-Cola back in. If it had been Royal Crown Cola, they wouldn't have had to put it back in. So there's always that struggle between the brands. I mean, and there always will be. But the retailers net, it has been moving in their direction, particularly, I think, because of the Amazon revolution.
First Walmart, and then...
Well, yeah, Walmart.
Right, and then
Walmart,
Amazon.
yeah. I mean, but it's been accentuated, I think. We have a new retailing environment now. I mean, it isn't like it goes from night to day, but it moves somewhat. And brands that people have spent billions of dollars developing and sponsoring TV shows or sponsoring radio shows in the old days. I mean, Campbell Soup was always on there with Jack Benny or something, you know, when I was a kid, and it was big. And it built brands, and people obviously like the product too. But people are more willing to change, and it's harder. It's a somewhat different world than what it is night and day. I mean, you are very unlikely to keep changing brands every day. But it really surprised me that Gillette lost position. I mean, men don't like to experiment much. Women are better experimenting. But you know, when you were a kid, the Gillette cavalcade of sports was your pal and brought you the Rose Bowl and you know the World Series and all that sort of thing. You just shaved with Gillette the rest of your life, and you still do to a great degree. But it's not exactly the same as it was even 5 years ago or so when we bought Kraft.
You mentioned Amazon as a game changer, and I have to ask you, you haven't bought the stock. You're an admirer of Jeff Bezos. A listing of the richest people in America came out. He's number one. I think your friend Bill Gates is number two. You're number three. So you can see what he's done in myriad ways.
Yeah.
And of course, the question is, How come you haven't bought Amazon? Is there still time to buy? Would you still buy it?
Oh, I always admired Jeff. I mean, I met him 20 years ago or so, and I thought he was something special, but I didn't realize you could go from books to what's happened there. No, I mean, he had a vision and executed in an incredible way, something that it would not have, you know, but there's a lot of games I miss. I would have missed, I would have missed Microsoft even if I gotten to know Bill earlier or something. Those just aren't my games. I don't worry about the things that I miss that are outside my circle of competence of evaluating. I have missed things that were within my circle, and that's a terrible mistake. Those are my biggest mistakes. You haven't seen them. But I don't, it's not a mistake because I miss Netscape or something like that at all. I would say that maybe 5% of the companies or 10% of the companies at most are within an area of my circle of competence. There's something I should be able to understand.
All right, well, let me switch gears then and ask you about leverage a little bit. And corporate debt, people are concerned about. People are concerned about federal debt at $22 trillion. Should we reduce, let's just say, the federal debt, and how would we do that?
Well, if you're running a deficit getting close to 5% when things are really good, that's a new world. And neither the Republicans or Democrats are particularly concerned about it. And we're not having a lot of inflation. That wasn't supposed to happen, but it's happening. That's why I say you don't want to get hung up on trying to make economic analysis because nobody's any good at you don't get rich doing that. If you look at, you mentioned that Forbes list, if you get on the list, the number of people have done that by economic analysis, I think you're just about zilch on there.
Okay, fair enough. Income inequality, wealth inequality, you've talked about the earned income tax credit. Is there more to it than that? Should we adjust tax policy? It seems to be going the other way right now.
Well, it is going the other way, but I think the earned income tax credit is the best way to put money in the pockets of people that don't fit well into the market system, but that are perfectly decent citizens and that have made a good bit of the success somebody like I've had with Berkshire or something possible. It wouldn't have happened without the America we have. And if you go back 200 years and we're all working on, 80% of us are working on farms. The person that's the best at that, working on that farm, whatever it may be, is worth maybe twice the ones that's the worst. I mean, that's the difference between super talent and no talent in the farm economy, picking cotton or whatever it may be. Now, if you're the best middleweight fighter in the world, you may get $20 or $30 million. And if you are just a good citizen, raise nice kids, help in the neighborhood and everything else, but you don't have market-related skills, you'd be good on that farm still. And you would be earning something comparable to most of the people around you. But you don't have something now that as it gets more and more specialized, and it's going to continue to get more specialized. You want two things for that person. You want them to have a decent life. I mean, they live in a country with 60,000 of GDP per person. You want them to have a decent life, and they can. I also think you want them to have a feeling of accomplishment. So you want them to have a job, assuming that they're not handicapped in some way. You want them to have a job. But the minimum wage would be one way to say, well, we'll make sure that they have enough money in their pocket. But that's got a lot of effects in disturbing the market system. They just need more cash. They don't need a higher wage. They need more cash in their pocket. And the government, at a relatively low cost, can provide a decent living for anybody that's working 40 hours a week and has a couple of children. And we've gone in that direction, and it's sort of bipartisan. I mean, you find both Republicans and Democrats for it. I think it would be better not to have one annual payment, that they get it monthly. And I think there's various things you could do, but you want them to feel part of the system, and you want to have them get, as more and more of these golden eggs are laid, you want them to get a little more of their share.
I mean, if we don't do that and the Democrats win, it's possible we get big taxes on wealthy people, free college for all, and those are bigger plans.
You want more money in the pockets of everybody that's willing to work or is unable to work. And we can do it. A rich family would do that. If I had 6 or 7 kids and I had some business I wanted to pass on, you'd pick the most able person to run it because that's the market system to do that. But you'd make sure that all 7 of the family participated. You'd give more to the one that you might give more to the one that kept producing the golden eggs. You would, but you wouldn't just say to the one at the lowest end, who might be the best kid of all in most respects. He's the one that shares with everybody and does all kinds of things. And you wouldn't say to that him or her that too bad, but that's just the way the market system works. Go have your spouse get a job and look for housing someplace.
Right. Why don't we do an update about the healthcare initiative, which now the company has a name.
Yeah,
Haven. Was that your idea?
No.
Sometimes
no, I didn't worry about a name. We could have gone on as a no-name operation for 10 years, as far as I'm concerned. No, that is. We got a wonderful partnership in the sense that it's large and has reasonable market muscle with more than 1 million employees among the 3 of us. We've got 3 CEOs that can make things get done in organizations that are so big that normally they would get very bureaucratic. If you tried to do this with many big companies, you'd have legal weighing in and public relations weighing in. We don't have any of that stuff. They may have them in certain areas, but I don't have to. But Jamie isn't going to worry about doing that sort of thing, and neither is Jeff. So we've got a unity of commitment and an ability to execute on the commitment. The only problem is you've got a $3.4 trillion industry, which is as much as the federal government raises every year, that basically feels pretty good about the system. As we went around talking to people to find a leader for the group, for example, everybody says, the system, it turns out very good medicine, but you can't go from 5% of GDP to 18, without really making it less competitive, among other things in the world. So everybody thought the system needed some adjustment, just not their part of the system, and that's very human. I do the same thing, I'm sure, if I was in the same place. So there's an enormous resistance to change, while a similar acknowledgement that change will be needed. And of course, if the private sector doesn't supply that over a period of time, people will say then, we give up, we got to turn this over to government, which will probably be even worse.
How often do you talk to Jamie and Jeff about it? I know Todd Combs, I think, is your point person.
Todd really does all the work at our budget. If this works, give Todd 100% of the credit from the Berkshire standpoint.
Does Haven have to buy companies to gain expertise? And what do you?
No, no, I don't.
What is the plan? I mean, how do you?
The plan is to support a very, very, very good thinker on this subject is a practicing physician and who commands the respect of the medical community to, in effect, figure out some way so that we can deliver even better care and have people feel better about their care too. I mean, they have to perceive that they're receiving better care over time and stop the march upward of cost relative to the country's output. We've got this incredible economic machine, but we shouldn't be spending 18% when other countries are doing something pretty comparable in terms of doctors per capita, hospital beds per capita, and all that. The very top stuff in medicine, I think, is very much concentrated in this country, and that's great. I want us to be the leader, but I just don't. I think we're paying a price. If we're paying 7 extra points of GDP, that's 1.4 trillion a year.
Is the administration focusing on drug prices? Is that sort of a rabbit hole? Is that missing the bigger picture?
I mean, they're trying, and Congress generally. I mean, if you talk to the average congressman, they regard it as a problem, and they see specific instances, of drug prices or something like that. But it's a big problem to change. I mean, the trouble is it intersects in so many ways, and that's why we've got Gawande heading it, and we've got 3 big-sized organizations backing him. We're not trying to do it to make money. I mean, that is not a goal that we end up with some business that we make money off of.
And will he be talking to health insurers, for instance?
Well, he'll be talking to everybody, but it is his game plan is not something we're going to try and lay out because it's in his head to some degree. I mean, obviously we selected him by hearing and reading and so on what he's done, but he'll learn as we go. We will conduct certain experiments, or he will, and try out a community where one of us has a lot of employees, maybe, and there's various ways to experiment.
Shifting gears, where do you find things like that Abe Lincoln tail and leg quotes? I mean, do you read Bartlett's book of quotations?
No, I
and
don't
find
read,
these
but
things?
probably 50 years ago I looked at a few Bartlett's quotations, but I read a lot. And
you just remember these things and apply
well,
them?
if you're 88 years old, I mean, you ought to remember something. Oh, you don't remember what happened yesterday, but you remember the old stuff. You've got a lot of interesting quotations in your head,
Yeah, not like you do. I think that's great. Okay, so one company you invested in was GE.
Yeah.
And you did well with that investment. And
yeah, I was too early, actually. If you look back, I was very active in the last half of September and early October, and then I wrote that article in later October. And I knew it was going to get bad. I wrote in the article it was going to get bad, but I didn't think the stock market would react as much as it did between then and March. So I had more or less used up our powder well before the bottom was hit.
it's interesting. How have you avoided not getting back into GE more recently? I mean, I'm sure that they've reached out to you. Everyone says, oh, why doesn't Warren Buffett invest in GE and save it and take it to the promised land? It's this great American company.
Well, actually, I think Larry actually is doing a good job.
Larry Culp.
Danaher, yeah, Larry Culp, but Danaher is a good sale. And I think his priorities are straight, and I think he's a very able guy, and he's on the right track. And I'm a fan of GE's in the sense that we're a big buyer from them, we're a big seller to them. I've known the managers. I mean, Jack Welch is a very good friend of mine, and we don't agree on politics 100%, but we have a lot of fun together, and I love the guy. So I've got a great desire for GE to do well. It just hasn't looked that attractive to me.
Right. You talked about the groves of trees in the letters shareholder. One was the third grove, which was sort of the in-between stakes. The
equity interests.
Yeah, and is it the case that those are sort of not the healthiest grove of trees? And why would that be?
No, those Pilot Flying J's they're companies that under GAAP accounting we have to record under an equity method. We own more than 20%, but we don't control them, and so it's treated under GAAP accounting as a special category, and it didn't fit well in the other grove, so I had to make it a separate grove by itself. It's not that significant a grove.
You say that the sum of Berkshire has a greater valuation than the parts.
That is true.
Did you ever try to calculate that? How much is that?
Well, it depends on circumstances. I mean, there's sometimes when the float from insurance can be very valuable. There's sometimes when the ability to use production tax credits, we'll say, in the utility business, but have them on our as part of our consolidated return helps. But that varies a lot. But it is a plus, and we can move capital. Well, take a business like See's Candy, which we bought 40 odd years ago. It's a wonderful little business. It throws off capital. We've tried 50 different ways to expand geographically, do all kinds of things. It doesn't work, and we'll try it again, and it won't work. But we can move that capital to help buy BNSF Railroad or do all kinds of other things. So we've got a seamless and tax efficient way of moving capital where it's needed. And we've got some companies that really chew up capital, and we got others that kick it off. And we can move it from one pot. If you try to do that with your investments, you incur some taxes as you go along doing it, and it's less efficient than what we've got.
You talked a lot about the tax cuts and the benefits to Berkshire. You didn't really get into the costs of the tax cut, which surprised me a little bit. What are there costs? I mean, is it just free money?
Well, it makes a difference. The tax cut we get, for example, our utilities, as I mentioned in the report, that goes to the customers. That's just the nature of utility regulation. But net, we were a significant beneficiary from the tax cut. I mean, basically, let's just say we had one class of stock. We got two, but stock, you and I own a business together, and we think we own all the stock. But the truth is, before the tax cut, the government had a 35% share of the stock on income. Now, it didn't have a share of the assets, but it had a share of the income. And if it wanted to change it to 40, it could have changed it, but fortunately it changed it to 21. And if we had a private business, if we had a McDonald's franchise together, or an auto dealership together, the third shareholder, that invisible shareholder, the governor, just handed us back a bunch of the shares of stock, and our shareholders benefited, and a lot of other shareholders benefited.
Right, you talked about Ajit Jain and Greg Abel saying that Berkshire blood flows through their veins. Have they made a difference since they become vice chairs? And then are they like Warren and Charlie?
No, they don't have the interaction. They each run a separate business inside. Ajit does not think about the other businesses. He thinks about the insurance business, and Greg does not think about the insurance business at all. And I think about the money and the capital and so on. But they're running two very big businesses. I mean, Ajit's business, has, when you go all told, at least a couple of $100 billion of assets, and Greg's business has $150 billion of revenues. I mean, they both would fit up there toward the top 10, or so in the country in terms of value. So maybe the top 15. But they're very big businesses.
But they're not exactly like you two guys. It's not.
Oh, no.
Right.
Charlie and I
That's
have a partnership thinking about the whole place,
Okay.
and we've done it forever, and we still do.
And Todd and Ted? I didn't see them mentioned.
Well, they have $13 billion each, including pension funds, that our pension funds, that they run. And so of the $173 billion we had at year end in equities, we had 173 bucks. We had another 8 billion in pension funds. So of the 180 or so, they had 26 between them that they're managing. And they got total discretion on that. They don't ask me. At the month end, I look and see what they did. They don't do much. They don't do a lot of trading or anything. But I look to see what changes they made. And Todd, for example, I mean, he made a couple of small investments in private placement type operations. And I know what the businesses do, but I can't tell you their names. That's his baby.
Was one of those, you made this investment in Oracle and then you sold it. Was that something they did?
No, that was not something they did. That was something I did.
Yeah, and you said you didn't understand it. That's why you sold it. But then why'd you get it in the first place?
Yeah, well, that's a good question to which I do not have a good answer. I know. I see development. I know enough about the cloud to know I don't know enough about the cloud.
Right. Okay. So Barclays put out a note. They said they were lowering the estimates for Berkshire for the EPS. Do you read that stuff?
No. Well, I may read it accidentally, but I don't seek it out to read. I'll put it that way. But it just doesn't make any difference. I mean, if I spent time reading that, I wouldn't have time to read 10Ks. And we're not going to do anything different. I don't know what we're going to earn. As I put in the annual report, and I really think this is unique. I mean, we do not prepare financial statements monthly for Berkshire. And there's just no other company would do it, but there's no sense doing it. I know where the money is, and I know how the companies are doing generally, but what difference does it make? Because I'm not going to try and hit any number for the quarter by, having a sale on insurance or doing something even worse. So And Charlie, I mean, he knows where we stand, and we know what businesses are doing well, which aren't, and we certainly know where the money is.
Another one, UBS survey of Berkshire investors says the 5 most important things to them are succession, investment performance, M&A opportunities, share repurchase, insurance margins. Do you read that, or does that
No,
surprise
but
you?
I don't disagree with that. I mean, I'm glad that somebody understands this.
Your own investors.
Yeah. Well, that's important. 54, well, if you go back to when I started my partnership in 1956 that Berkshire came out of, there were 7 people sitting there at a table having dinner, relatives primarily. And I said, here's the partnership agreement. It's done under Nebraska law. It's 4 or 5 pages. You don't need to read it. But I said, here's a little half-page, what I call the ground rules. And I want you to read these. And if you feel okay about that, about the interaction, what the expectations are, and all of that sort of thing, then we'll join forces. And if you don't, it's fine. Other people have, but we shouldn't be partners. I mean, if I'm going to have a partnership with somebody, I want it to be compatible. It is, and when you have a public company, you can't control who comes in. I can't control some guy that comes in and thinks we're going to pay big dividends or split the stock or something like that. So by my actions and my communications and everything, I want to attract the people that from the public market that I want, and I want to keep the others away. Costco was built. Saul Price, who started the Price Club and that thing, he sat down and figured out the customer he didn't want. And he set up a system that would keep away the customer he didn't want. Who did he not want? He didn't want somebody buying a quart of milk with somebody behind him with a basket of $200 worth of goods waiting for that. So he put in a membership fee, and by putting in a membership fee, he killed all the drop-in business, the business that belonged to the 7-Eleven. We want Berkshire to keep out people who have expectations about us that are different than ours. I mean, good for them, and I hope they find somebody they fit. But if you're going to run a church, you want your seats to be filled by people that are generally want to listen to your form of religion. And you don't want it to change every week and say, gee, I need a new group, and I'll go out and talk to a bunch of investors and get them to come to my church this Sunday. Because there's only so many seats in the church. There's 1,645,000 or so A-equivalent shares, and those are the seats. And I want them occupied by people that are on the same page I am.
The Church of Berkshire. Seems like you've got a big weighting in financials, and of course you finally invested in Jamie Dimon's company. Why banks right now?
They're businesses I understand, and I like the price at which they're selling relative to their future prospects. I think 10 years from now that they'll be worth more money, and I feel there's a very high probability I'm right. And I don't think they will turn out to be the best investments at all of the whole panoply of things you could do, but I'm pretty sure that they won't disappoint me.
Is climate change changing your insurance businesses?
No, it doesn't change the insurance business.
Does it change modeling or something in the business?
No, it would change our insurance business if we were writing 20-year policies. I mean, if there was something that changed life mortality adversely to the interests of the life insurance company, you're stuck with a policy for 20 years if you write the life insurance policy, and it's, you'll keep paying your premiums if it's adverse to me. That's what's happened in long-term care insurance, for example. But when you write a policy for 1 year at a time, you see what the developments are, and if cars, for example, are much safer to drive than they used to be. There used to be 15 deaths per 100 million miles driven. Now there's a little over 1. On the other hand, they've become much more expensive to fix. I mean, that little side view mirror, which used to cost $10, now $1,000 or something like that. So you have things that are changing in terms of, if you're writing collision insurance, you got to allow for the fact that windshield, the bumper, all kinds of things, or the side view mirror and all that are way more expensive. But if you're writing liability, you know that people aren't going to die as often. So climate change is climate's been changing. But the truth is that you now can buy really big catastrophe limits cheaper than you could buy them in 2005 or thereabouts. allowing for changes in the dollar and concentration of population. So far, rates have come down. That's the reason we've gotten out of the cat business to a great degree. We were a very big writer of cat business 10 or 12 years ago. We aren't out of the cat business because of climate change. We're out because the prices aren't right. And the world will change, and that's got very serious consequences, but it won't change that much from year to year. That, we've done very well during a period of some climate change.
You've talked about technology advancing faster than our ability to understand it. And I'm wondering if social media and Facebook and Google and Russian trolls coming in, and is that maybe an example of that? Or are you still worried about that problem?
Well, I think cyber poses real risks to humanity, forgetting about the problem of even misinformation. I'm just thinking of, we have railroads running over 22,000 miles of track, and some of them are carrying ammonia, and some of them are carrying, chlorine and things. We have to carry them. We have no choice about that. We're required by law to carry them. And I would rather do that in a non-cyber world than a cyber world. And there are all kinds of things. The problem about something like cyber is that it's moving, and it's just unpredictable whether you'll get some crazy guy like stuck the anthrax in the, what they can do becomes magnified. I mean, when you saw what 19 guys did, on 9/11. I mean, tools in the hands, or potentially in the hands, of either crazy individuals, crazy groups, or even a few crazy governments, are really something. And we don't necessarily know what all the tools they have are, and that is moving all the time. I mean, again, Einstein said, I know not with what weapons World War III will be fought, but World War IV will be fought with sticks and stones. I mean, it's a dangerous world.
I don't know if you've been following this, Warren, but what do you think of Elon Musk's behavior as a CEO?
Well, I think it has room for improvement. Now, he would say the same thing. I mean, it's just some people have a talent for interesting quotes, and others have a little bit more of a blocker up there that says this can get me in a problem. But he's a remarkable guy. But I just don't see the necessity to communicate. I think I've got 7 tweets because a friend of mine signed me up for it, and she's called me about 100 times saying, can I tweet this or that? And I've said yes to her 7 times, I guess, or something like that. I've never actually written one myself. I don't even know how to do it.
Have you talked to Elon ever?
He joined the Giving Pledge, so once or twice, but that's a lot of years ago. 7 or 8 years ago. He hasn't come to our annual gathering, so I haven't seen him for 7 or 8 years.
So let's talk about this trade war that's been going on a little bit with China. And I guess I'd like to ask you, do you think that Donald Trump was right in calling out the Chinese government and basically putting them on notice?
I won't have any comment on that. In terms of political activity, I don't put my citizenship in a blind trust. So when the election comes around, I'll do something. On the other hand, people will interpret things I say about any president, as to some extent coming from Berkshire, and they don't come from Berkshire. I'm just an individual. So I think. I'm glad to talk about China, but I can't talk to you about that part of it.
Fair enough. I mean, do you think there was room for improvement then in terms of the trade relationship between China and the United States?
Well, I think that China and the United States absolutely are destined to be the superpowers, beyond my great-grandchildren's lives, and will always be competitors, and will be competitors in business, we'll be competitors in ideas, all kinds of ways. And there's no other way it would be. and we just have to make sure that that competition doesn't get us to a point where we don't realize that the best world is one in which both the United States and China prosper. I mean, we do not want to have an island of prosperity in the rest of the world, envious of us in a nuclear age. And China doesn't, Russia doesn't. I mean, we all recognize the dangers of letting competition get out of control and become, you can be competitors without being enemies. And that's what all powerful nations have to realize over time. I mean, it's different than 200 years ago when you could have some dominant country, and then they may have done some things that you didn't like, but it didn't threaten the existence of the world. You really threaten the existence of the world as we know it if important countries do not constantly recognize that they can compete, they can fight over certain things, but they can't regard it as essentially the equivalent of war.
Here's a question from Kevin Chen, who is a Berkshire shareholder and an NYU professor. And he says, and this is sort of along the lines of what you were just saying, Warren, but do you think that U.S. and China will be able to resolve their differences, or are conflicts unavoidable?
Well, I don't think conflicts are unavoidable, but I think it has to be active thinking on the part of every hugely powerful country. And Russia is hugely powerful. I mean, 90% of the nuclear arms in the world are between U.S. and Russia. So they have to recognize that the best world for them is one where they don't try and grab all the apples, basically. And we have to recognize that. And we can't, in the United States, we can't think that either our ideas run the world, or we start getting aggressive about things, and China can't think that, and Russia can't think that. And that's obvious. You just have to make things, you got to be sure things don't escalate. You have World War I, with an archduke, I mean, you get these, you can get chance incidents, and you really want to, I asked one of the presidents one time, in terms of what he would do if awakened in the middle of the night with somebody coming to him and saying, absolutely, somebody else has launched, and would you launch on that? And you've got 10 minutes to decide. And I wouldn't want to have that responsibility, but you want to make sure you don't get to that point.
Right, right. Would you ever make a big acquisition in China? And if not, aren't you missing a huge portion of the world?
Yeah, the answer is we would. Yeah, we would.
Have you looked?
We've been made aware of some things, yeah.
Are you concerned, on the flip side of the coin, are you concerned that the rule of law is different, that the accounting might be opaque?
Well, I'd want to be sure I understood the accounting, obviously. In some businesses that'd be easier to do than others. But I know the laws, the customs, the accounting, the people better in the United States than any place else. So there's some small hurdle in many countries to get over, which I can get over. I mean, but I just don't. It's just not as easy as looking at something where I already know the answer, from previous transactions or something of the sort. So it's easier to make a big acquisition in the United States. I have to do more work if I'm looking beyond the borders. But I love the idea of doing it. When we made the acquisition in Israel a dozen years ago, I didn't know what the tax rates were there. I didn't know what corporate law. I suspected that it would all be answered satisfactorily, which it was, but I didn't just automatically know it.
It seems like you're more open about doing a deal in China than in previous conversations.
I don't think so. No,
It's out there.
I'm open. Yeah,
Right.
we made 2 decent-sized stock acquisitions there, and they worked out fine.
Those are?
Well, PetroChina and BYD.
BYD, yes.
Yeah, BYD was Charlie's, but
Right.
Charlie's very well versed on China.
Right.
But,
The U.S. trade deficit has been widening, and of course a lot of that has to do with our trade with China. Is that something that worries you?
Well, I wrote an article about it for Fortune and the trade situation many years ago, and when our deficit got to be large in relation to GDP. I don't think it's essential to have a trade balance, but I think that if a trade deficit gets large and it looks like you have no way out from it, that can be a real problem over time. I mean, you're shipping little pieces of paper to the rest of the world, and they're shipping you goods. I mean, people are working, making underwear or shoes someplace, and they get little pieces of paper from us. And it gets very tempting if you've done that enough to make sure that those little pieces of paper aren't worth very much over time when they want to cash them for something. So you don't want to have, we don't have any problem running trade deficits, but if we ran really large ones and we sort of worked ourselves into a box where we didn't really have a solution to get the numbers down, it could be a problem. And I wrote about it one time, but it's kind of a nice thing, actually. Just, I mean, wouldn't you like to have something where you just send out little pieces of paper and somebody keep supplying you with your food or your, whatever.
I'm living it.
Right? Yeah, right, exactly. Yeah,
Yes.
We call them credit cards in the United States.
Exactly, yes. Okay, and last question. China is facing its slowest growth in nearly 3 decades. The leadership there lowered the targets, I think, to around 6.5%, 6%. Are you concerned about this slowing growth and the impact on global markets?
Well, I don't worry about it in terms of global markets. I mean, China's going to grow a lot over time. I mean, when you think of what's happened, well, this is 1949 or whatever, but there's been nothing really like it. I mean, you had 20% of the world's population at that time, perhaps, really hadn't remotely achieve their potential. I mean, they had the intellectual capacity, they had a decent soil, all kinds of things. I mean, and what's happened there almost is beyond belief. And that game's not over, but we've had incredible developments in the United States. I mean, real GDP per capita is 6 times what it was the day I was born in the United States. 6 times. And we thought we were a pretty developed country then and everything. No, my parents wouldn't have believed it. I mean, they would have thought, that this kid has really got it made. I think more in the United States, and it was true. I mean, we had this tailwind, and China's had a hurricane behind it, in recent decades.
In a good way.
Absolutely.
Because you were comparing it to the tailwind of the hurricane at your back.
At their back, and they have found a way of life that is dramatically different than existed for the billion. There was a billion then, maybe a billion, 2 or 3, whatever it is now, and they have changed a country really of size. I don't think there's ever been anything like it. We've done it too, but it took somewhat longer. I mean, it was more stretched out. It was a remarkable period, but when you go to, I first went there in 1995, and then they regarded it as a miracle, and then I went back 10 years later, and it was a whole different country beyond that.
Warren Buffett, thanks so much for joining us. I'm Andy Serwer. You've been watching Influencers. We'll see you next time.
We are here in Omaha, Nebraska this morning with Warren Buffett, the chairman and CEO of Berkshire Hathaway. He's just released his 55th annual shareholder letter to the shareholders over this weekend. And this is actually the 13th year that we are now in Omaha talking to him after that letter. This is a show that we call Ask Warren, so that people can write in their own questions to Mr. Buffett after they've read that shareholder's letter. But obviously this morning, given the news, there are a lot of other questions that people have concerning the stock market. Let's jump right into it with Mr. Buffett, who is here with us right now. And Warren, thank you for being here today. It's good to see you.
Thanks for having me.
I want to talk about the letter. Obviously, one of the things that you touch on in the letter is when people should be buying stocks. We're going to dig into a lot of it, but when you're looking at the futures down about 818 points this morning, I think probably the first thing viewers want to hear from you are your thoughts on what's happening with the coronavirus, if this is a reason to panic, and if you are worried about this.
Well,
I don't know. I have any special thoughts beyond the news on the coronavirus. The very first day I bought stocks was March 12th, 1942. And the stocks were down about 2% that day, as it turned out. Unfortunately, I bought in the morning. So when I came home in the evening and my dad told me the execution price, it was down 2%. But if you're buying a business, and that's what stocks are, businesses. In fact, people will be better off if they say, I bought a business today, not a stock today, because that gives you a different perspective on it. Then presumably you can buy a farm, if you buy an apartment house, if you buy a business, you're going to own it for 10 or 20 or 30 years. And the real question is has the 10-year or 20-year outlook for American businesses changed in the last 24 hours or 48 hours? And you'll notice many of the businesses we own, partially own. American Express, we've owned it for 20 years. Coca-Cola, we've owned it for 40 years. Those are businesses. And you don't buy or sell your business based on today's headlines. And if it gives you a chance to buy something that you like and you can buy it even cheaper, then it's your good luck, basically.
Although there are a lot of people who look at the market and they say, look, I want to buy, but I don't want to buy when the market's sitting at new highs, when it's been hitting new records every day. Maybe it's off 800 points this morning, but maybe there's more of a decline to come because the effect of the coronavirus is going to be an impact on the global economy. IMF said that over the weekend. You are going to see weakness as not only China, but other countries try and address this. You're right, it may not change things over the 5 or 10-year span of things, but if I think that I can buy something for potentially 10% cheaper, maybe more than that if I wait a week or a month, maybe that's what I'm sitting around.
Well, if you think that, then you're going to get fabulously rich if you're right. All you have to do is just keep buying at 10-day intervals and keep taking your 10-day prediction. If I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price. Everybody, when they buy a stock, if you're going to buy, say, General Motors that has 1,400,000,000 shares out, you should be able to take a yellow pad like you have there, and on one page say, let's say it's selling for 30. It isn't selling that low, but that'd be 42 billion. You should say, I am buying the General Motors company for $42 billion because, and you should get it on a piece of paper. And then if you want to have a separate piece of paper, it says, I think I know what the stock market's going to do, so I know whether it'll be higher or lower in it. But you don't. You don't have that.
But if I worry that the economy is going to slow down, not just for the quarter, but for the year, that would impact how many cars I think they might be able to sell or even produce.
I'll guarantee you cars are going to slow down someday. In 1932, General Motors had 19,000 dealers. That's more than all the auto dealers in the United States today. There were only 125 million people then, but they had 19,000 dealers. They produced or sold, and there was 1 month, I think, when they sold less than a tenth of a car, right at a tenth of a car per dealer. That was a terrific time to buy General Motors. and forget about the market. If you can predict the market, you don't need to read balance sheets. You don't need to read anything. You certainly can't predict the market by reading the daily newspaper. That is for sure. And you certainly can't predict the market by listening to me. But you're buying businesses. And if you had planned to buy a local service station yesterday and it was closing day, I don't think you'd tear your hair out or anything like that. You'd have already looked at where it was located and the contract that it had with the suppliers and made a decision on competition. People, because they can make decisions every second in stocks, whereas they can't with farms, they think an investment in stocks is different than an investment in a business or an investment in a farm or investment in an apartment house. But it isn't. If you get your money's worth in terms of future earning power over the next 10 or 20 or 30 years, you're going to have made a good investment. And you can't pick them from day to day. If you can do that, you can, well, I haven't met anybody yet that knows how to do it.
You made a point of that in the letter this year where you highlighted a book that was written by Edgar Lawrence Smith back in 1924. And you said until he came along, nobody really realized the compound interest effect of buying stocks, not just buying businesses, but buying stocks themselves.
Edgar Lawrence Smith changed the world with that book, and the people have forgotten all about it now. Although in the 1920s, it became more and more gospel as the boom went on. But Edgar Lawrence Smith set out to write a book on bonds versus stocks. And he said if he went in with the idea that bonds would be a better investment in times of deflation and stocks would be a better investment in times of inflation. And the first line of his book was to say that he'd been wrong. But he had enough sense to look at his evidence. I think Darwin said if you found evidence that was contrary to what you already believed, write it down in 30 minutes or your mind will just block it out. I mean, people have a great resistance to new evidence. And he said, if a stock yields 4% and a bond yields 4%, which was what he was talking about then, the stock was going to outperform the bonds because there were retained earnings that were building beyond that yield. And that had been true for a long, long time, but nobody paid any attention to it. We don't get rich on our dividends that we receive, although we're happy to receive them. We get rich on the fact that the retained earnings are used to build new earning power, repurchase shares, which increases your ownership in the company. And Berkshire has retained earnings ever since we started. That's the only reason Berkshire's worth a lot more, as we retain earnings.
That led Keynes to actually say that this was an important book. People paid attention to it, but you're right, it added to the frenzy that built up to 1929.
Well, that is true because you can get, old boss Ben Graham told me very early on, you get more trouble with a good idea than a bad idea because the good idea works. I mean, it's a good idea to buy a home, for example, and then people go crazy. The good idea works, and it works, and it works. Stocks work out better than bonds most of the time. And after a while, people forget that there were some other limiting conditions. With Edgar Lawrence Smith's book, it was that when bonds yield the same as stocks, which was the case then, that stocks are going to outperform because they have this retained earnings. So stocks started going up in the 20s, and all of a sudden they were selling at 5 or 6 times the prices as when he bought the book. And the original correct perception on his part had experienced changing conditions, but people just looked, they got their confirmation through stock prices. And that's what happens in bull markets. People start out thinking stocks are cheap, and then they start thinking stocks have gone up. And a stock can be a good buy or a bad buy. A bond can be a good buy or a bad buy. It depends on price.
But that leads us to today. I mean, if his premise was that stocks are always going to be a better investment than bonds, that's kind of what you hear today, which we've been hearing for a while, is Tina, there is no alternative, right? You have to buy stocks because bond yields are so low, because interest rates are so low.
Well, if you look at the present situation, we've talked about this before, that you get more for your money in stocks than bonds. That doesn't have to be the case. I mean, but it's usually been the case in America, very usually been the case. And if you buy a 30-year bond today with a yield 2%, you're paying 50 times earnings for an investment where the earnings can't go up for 30 years. Now, if somebody said, I want to sell you a stock that's at 50 times earnings and the earnings can't go up for 30 years, you'd say that doesn't sound very good. Stocks are way better than 30-year bonds. I mean, that's clear. And that's one of the alternatives people have. People really have 3 basic alternatives: short-term cash, which is an option of doing something later on; long-term bonds or long-term stocks. And stocks are cheaper than bonds.
Charlie said recently, Charlie Munger, the vice chairman at Berkshire Hathaway, had his daily journal meeting just a couple of weeks ago. And at that meeting, he said that there's a lot of wretched excess out there and that there's a lot of trouble coming as a result. Do you agree with that?
There's always trouble coming. Yeah, there was trouble coming in 1942 when I bought that first stock, all kinds of trouble. Philippines were going to fall pretty soon. There was all kinds of trouble in 1949. There was trouble, certainly trouble in 2008 when I wrote an article for the New York Times. I said trouble is coming, but I said buy stocks.
Would you repeat that this time? If trouble's coming, would you still say buy stocks right now?
I would say buy stocks if you get enough for your money. And, you know, we buy a few stocks, but we don't look at, we're not buying the stock market. We're saying, I am buying, let's say American Express. We own American Express. You know, there's 815 million shares out and sells it. This morning's 126 or something like that. So it's selling for roughly $100 billion. Now, the real question is whether the company's worth more or less than $100 billion. It isn't what the stock is going to do tomorrow or next week or next month.
You said just a few minutes ago when we asked you on Worldwide Exchange, right now Berkshire Hathaway is a net buyer of stocks. You are in a net buying position?
We've been a net buyer of stocks, or I've actually been a personal net buyer of stocks ever since I was 11, every year. And there's been 15 American presidents in my lifetime, more than a third. I've lived under a third of the life. I didn't buy stocks under Hoover. I was only about 6 months old then. But there have been 7 Republicans after that and 7 Democrats. I bought stocks under every one of them. Now, I haven't bought stocks every day. There have been a few times I thought stocks were really quite high. And I've even written an article once or twice, but that's very seldom.
But you wrapped up your partnership at one point.
I wrapped
too,
up my partnership once
because you thought it was too expensive.
Yeah.
Okay. But this is not a time like that?
We own $240 billion worth of stocks. Now, we look at that as $240 billion worth of businesses that we own parts of. But I love owning those businesses.
You've also got more than $125 billion in cash sitting around.
Yeah, well, we'd like to buy more businesses.
We are here, Warren, with you at Berkshire Hathaway's headquarters building. This is upstairs in the room that's called the Cloud Room. And this is a room where you often take students to kind of talk to them about questions they have when they come to visit you. You also do some other things up here, too, other presentations.
Yeah, I had students here for dozens of years. And for many years, 40 schools would come in. They'd come in groups of 8. At 5 days, I'd spend a year, and they come from all over the world. We had them from Peru, we had them from China, we had them from Israel, and we had a good time always. I've given it up now, but I started teaching when I was 21, and when I got to about 88, I thought, I'll take a rest.
Well, there are a lot of questions that are coming in from viewers that have been hitting here today. They're waking up this morning looking at the stock market indicated down by almost 800 points for the Dow. We're actually off our worst levels of the morning, which is something to say when you're still looking at the Dow down by about 786 points. But people have a lot of questions about the economy. They're wondering what's happening right now, particularly with the coronavirus out there. You have a lot of economic data at your fingertips because not only are the many businesses that Berkshire owns, but the businesses you own pieces in. What are you seeing right now around the globe?
Well, it affects various businesses. I would say that I received commentary. I get some commentary monthly from almost all of the companies, and a good many of them had some comment about how it was affecting them, and however it was affecting them at that time, I'm sure it's accentuated. But they were affected by tariffs, they're affected by taxes, they're affected by, the most thing is they're affected by competitors and supply and demand over time. And I don't have the faintest idea what our businesses will be doing 6 months from now or 12 months from now. I do think that not only our businesses, but American business generally will be doing fabulously better 30 years from now or 20 years from now. And the long term is in my view, is very easy to predict in a general way, but in an important way. I don't think there's any way to predict what the stock market will do 10 minutes from now, 10 days from now, or 10 months from now. So I work on what I think I'm able to do, and as desirable as it might be to know what was going to happen 10 minutes from now, that's just not something I'll ever be able to master. So fortunately, I can come to a pretty firm conclusion that 20 or 30 years from now, America business, and probably over the world, will be far better than it is now.
What are the momentary implications that you've seen from coronavirus? What's an example of a business?
Well, an example, for example, we have maybe 1,000 Dairy Queen franchises in China here, and they're just treat only, so they're the older type, not with food. But a great number of them were closed, but the ones that were open weren't doing any business to speak of. And Apple is, I mean, our much bigger holding is Apple. We own 5.6% of Apple, and the company came out and said that it's affecting not only its stores, but all kinds of things, supply chain. And I find that certain of our companies have got supply chain arrangements that are being affected by this that I didn't even know had those.
Like what?
Well, I got one from Johns Manville the other day, for example. You wouldn't normally think of them as having a big supply chain, but Shaw Carpets, or you name it. I'll guarantee you that a very significant percentage of our business is one layer affected by it. But they're being affected by a lot of other things, too. And the real question is where are those businesses going to be in 5 or 10 years? They'll have ups and downs. Our candy business is a wonderful business, but it loses money 7 months out of the year. But the nice thing is Christmas comes every year.
When you look at the economy and how things were kind of chugging along, let's say beginning of this year,
Yeah.
when things first picked up, how would you gauge the U.S. economy at that point?
Well, it's strong, but a little softer than it was 6 months ago. But that's over a broad range of business. You look at car loadings, rail car loadings, that's moving goods around. And there again, that was affected by the tariffs too, because people front-ended purchases, all kinds of things, always a lot of variables. But business is down, but it's down from a very good level. So I would say that looking at our 70 businesses, and that actually, they represent hundreds in addition, they're a little softer. On the other hand, I was out with the fellows from the Nebraska Furniture Mart just Saturday night, and their business was up quite a bit in February, but that's because weather was good. So you have a lot of variables that hit.
Why do you think business was down, let's say, the last 6 months? Is that a decline in confidence, or is it coming off of levels where there was unusual activity ahead of that?
Well, it isn't really down. It's just it leveled off and a little softer maybe now. But, well, tariffs, the tariff situation was a big question mark for all kinds of companies, and still is to some degree. But that was front and center for a while. Now coronavirus is front and center. Something else will be front and center 6 months from now, and a year from now, and 2 years from now. The real question is where are these businesses going to be 5 and 10 and 20 years from now? Some of them will do sensationally, some of them will disappear, and overall, I think America will do very well. It has since 1776.
But you still watch things like rail car loadings very closely.
I watch everything, but I don't do it to make specific investment decisions. But I enjoy. I mean, I want to know what's going on, but I also don't think that I can make money by predicting what's going to go on next week or next month. I do think I can make money by predicting what's going to happen in 10 years.
All right, well, tell us more about what's going on, just since you like knowing about those things.
Well, as I say, certain businesses depend on weather to quite an extent in retail, for example, in given months. But the big trends you see are going on. I mean, in terms of the movement to online commerce, and I mean, the big stuff keeps moving. But we've got a big investment in the airline business, and I just heard, even more flights are canceled and all that. But flights are canceled for weather. It so happens in this case they're going to be canceled for longer because of coronavirus. But if you own airlines for 10 or 20 years, you're going to have some ups and downs in current business, and some of them will be weather related, and they can be all kinds of things. The real question is how many passengers are they going to be carrying 10 years from now and 15 years from now, and what will margins be, and what will the competitive position be, but I still look at the figures all the time. I'll admit that.
You mentioned the airlines, and you own stakes in all the major airlines, but none as much as Delta. I think you own north of 11% of Delta at this point.
Well,
right.
We own our largest position is in Delta. 3 of the 4 positions are mine. 1 of the positions is one of the other fellows of the 4 positions. But we own a very roughly close to 10% of the 4 largest airlines.
There's been a lot of speculation. In fact, some of the questions that came in over this weekend were questions about those airlines, wondering if you would buy any of them outright. Have you considered buying any of those companies outright?
It'd be very unlikely we would do that. I'm not saying it's impossible, but it's complicated.
Why?
Well, for one thing, they're regulated, and there's an interplay. I'll just give you an example, not that we'd be doing, but with Delta, we own 18% of American Express, and American Express is a bank holding company, and bank holding companies have limits as to what they can do, and we're a passive holder of a bank holding company with American Express. But then if we owned an airline that was tied up with them, they'd have lots of arrangements. There's a lot of complications because it's a regulated industry. Anytime you get in a regulated industry, you have more complications in transactions.
So is it fair to say you like these stocks and you would own more if it wasn't complicated?
Well, to go beyond 15% in any company, we would have to go in on Hart-Scott-Rodino. I mean, there's a lot of rules as you increase your ownership. Obviously, almost anything we own, we'd like to own more of.
Are you buying more of any of those stakes right now? Apple
well, right.
shares?
I get pretty close-mouthed when it comes to what we're buying.
You thought about that for
I
a
feel
second.
my jaws lock up.
But fair to say,
it's fair to say that anything that we own, we like. There's very few stocks that we own, and I look at them as part ownerships in businesses. There's very few that are selling at some price where I would sell them a little higher.
all right, well, let me ask a question that came from Tony Dickinson. He said, in the fourth quarter, Berkshire sold 55 million shares of Wells Fargo. Should shareholders view this as a lack of confidence in the new CEO turnaround plan? And what is Warren's future outlook for Wells Fargo?
Well, I won't give him any advice specifically on Wells Fargo, but it's absolutely true that we've sold down our position. Some of it was sold down to avoid being over 10%, because then you do have some filings with the Fed and so on. But
They've sold well more than that.
Yeah, we've sold well more than that.
I think 8.4% was the last.
Yeah, that sounds right. And no, we sold Wells Fargo in the fourth quarter, and we sold it earlier.
Can I ask why? Only because I did get a number of questions.
Yeah, well, I can understand that, but we just don't want to give any advice on what we're doing, because I could change what I'm doing tomorrow. We talk about everything except we don't give stock advice.
Okay. I'll try one more from Tony
Okay.
Dickinson, just because I think I got 15 or 20 different questions on this. Berkshire owns $32.58 billion of Bank of America and $17.39 billion of Wells Fargo. One position's been increasing while the other's been decreasing. Does Warren like Bank of America twice as much as Wells Fargo? And how should shareholders view the holdings?
Yeah, well, I think they've seen that we bought Bank of America and we've sold some Wells Fargo.
All right, let me ask you a broader question that comes in just on interest rates and the impact that might have as well. Varun Jain writes in on Facebook, hi, I'm a huge fan and a student of Mr. Buffett. Please ask him, what impact does the zero interest rate environment across places like Japan and Europe have on their banks, whether the business is still good? And does the prolonged low interest rate regime in the United States hurt the prospects of American banks like JP Morgan, et cetera? And in such circumstances, do Indian banks, which have high return on equity, look attractive to Mr. Buffett?
Yeah, well, I can't comment on that latter, but generally speaking, but there are a lot of other variables too. But the banks are going to make more money if there are higher rates with a steeper curve. The curve is more important. In other words, the 10-year versus short-term rates may make more difference in the absolute level. But American banks have made very good money with very low interest rates. Around the world, if you look in the UK or Europe or Japan, even lower rates have made it pretty tough for banks. The returns on equity are not as high, and they have to use more leverage to even get the same returns, and I don't like that as well.
If you are talking about the curve that we're looking at this morning, the 5-year, 2-year is inverted. 2-year 10 is not right now, but the 10-year is below 1.4% this morning.
And think about it, the 10-year at 1.4%. That means you're paying 70 times earnings for something that can't increase its earnings for 10 years.
Okay,
now,
if
somebody came to you with a stock and said, you know, this is a terrific stock. It sells at 70 times earnings. The earnings can't go up for 10 years. You'd say, well, explain that to me again.
Right.
But no, we've never seen a situation like this in the world, literally. I mean, you can go back and read Keynes, and you can read Adam Smith, and you can read, all the great ones. And they don't talk about negative interest rates. It never crossed their mind. How much supply and demand, all these marginal costs. But brilliant economists never really anticipated that you would have negative. You've got 13 trillion or something like that worldwide at negative interest rates, and we don't know what that means. We've got a lot of people who can speculate what it means, but 10 years from now or 15 years from now, we'll look back and say, well, it's obvious what would happen under that, and we'll see it. But it is not a normal situation, and well, interest rates are the basis of all value. I mean, if you knew interest rates were going to be zero for 100 years, you would think 1% was a great rate of return. But you also would know if you bought something that was yielding 1% or that was what it paid, and rates went to 8%, you'd lose practically all your capital. So it's an enormous factor, and we don't know the answer. Central banks don't know the answer. All we know is that it's been useful in stimulating things, and particularly asset prices, now for 10 years. And what we thought was temporary in 2008 and 9 in the way of monetary policy to stimulate, we've just put our foot on the gas even further. The whole world has.
You made a point in the letter of saying that you don't know how long these interest rates will last. You and Charlie never try and figure these things out. But we did have St. Louis Fed President Jim Bullard on the program last week, and he said that he expects to see these low interest rates for a long time to come. That does raise a lot of questions, if that happens, about what this means for the stock market, what that means for banks, what that means for insurance companies, which you touched on in the letter, too.
It's bad for insurance companies, but it's good for stocks.
Bad for insurance companies, and what happens to the insurance companies as a result? Are they getting more?
Well, it depends
are some insurance companies kind of pushing out risk?
The ones that really get hurt on it are either life or annuity companies that have promised returns. The property casualty business doesn't promise returns. It still holds money, so it hurts them. But if you promise somebody an annuity that's going to pay them 3 or 4%, and now you find that you're reinvesting your money at 1% or something, you know, you're going to disappear.
Are insurance companies being forced to make riskier and riskier bets?
Well, they shouldn't be. I mean, the answer, if you need to get 3% and you're only getting 1%, the answer is to quit giving 3%. It's not to try and get the 1 up to 3 and do more dangerous things. You should always adapt your consumption to your income. You shouldn't try and adjust your income to your consumption. That's a basic principle for individuals, businesses, and everything else. And reaching for yield is really stupid, but it's very human. I mean, and I understand it. And people say, well, I saved all this money all my life and now I can only get 1% out. What do I do? And the answer is you learn to live on 1%, unfortunately. And you don't go and listen to some salesman come along and tell you, I've got some magic way to get you 5%.
Do you think, though, that's what should be happening? Do you think that there is more risk taking place in the insurance market as a result?
And you see that in what they call leveraged loans and weaker covenants. No, people are reaching for yield. There's no question about that, and that's stupid, and it has consequences over time. But it's very human.
Consequences that could have a big market impact.
Depends how far it goes. Yeah. It's something that the things that get built in slowly, people going crazy in tech companies in the late 1990s, it can take a lot longer than you think. Mm-hmm. But eventually you get to midnight and everything turns to pumpkins and mice.
You know, that's the downside of low interest rates, pensions, savers, anybody who gets left in a raw position of that. On the alternate side of things, if rates were to rise rapidly, or maybe not even so rapidly, what does that mean for the federal debt?
Well, it depends on the average maturity of the debt, but our maturities are fairly short. They've gotten lengthened a little, but if you take 20 trillion and you're borrowing at 2%, you got 400. What have you got? 2 trillion to 200 billion. You got 40 billion of the expense. But if it goes to 5%, you got 100 billion of expense. I mean, at 5%, you got a trillion of expense. I'm sorry. We are benefiting enormously in our national budget by the fact that interest rates are very low, and so interest cost has not gone up as you would have anticipated if you were looking at the scene 20 or 30 years ago with the increase in national debt. Austria issued 100-year bonds, at 2% or thereabouts, and then they've gone way, way up. And I think maybe they yield 1.1 or something like that. I don't know where they are now. But it's great if you're a borrower to have cheap money. I mean, everybody should refinance their mortgage.
Is that an argument for the Federal Reserve, or I'm sorry, for the Treasury Department here, issuing longer notes?
Well, yeah, but I would have said the same thing 5 or 6 years ago and been wrong. But if we, under the present slope, it still would cost more to lengthen it out, but you're lengthening it out at very, very low rates, and it would be what I would be inclined to do if I were Secretary of Treasury, but I'd have missed a lot of bets in the last 10 years too.
Warren, again, for people who are just waking
Sure.
up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning,
Yeah.
what's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. So if that's a roughly a 3% decline or thereabouts. I don't know how many 3% declines I've had in my lifetime, but there have been a lot of them. And I can't think of one that you shouldn't have bought on, basically. That doesn't mean stocks are going to go up or down next week or next month or next year. But if there's something, if you like to own American businesses, you're getting a chance to buy it 3% cheaper. I don't consider that a lot cheaper. I mean, but how can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it could be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference to you.
Does that mean Berkshire will be buying stocks today?
Well, we certainly won't be selling, and yeah, we could easily be buying something, sure.
Okay. Let's talk a little bit about a Barron's cover story that was just out last week. The good news on the cover story is they think the Berkshire is worth more than it's selling for right now. The bad news is they said they think that's in part because it's got a big conglomerate discount, and they think if you weren't running it, that it might get broken up. What's your response to that line of logic?
Well, conglomerates have had a bad name, and for good reason over the years. I mean, I closed my partnership up at the end of the 1960s, and there was a very abusive run in conglomerates where they played with numbers and they had dirty pooling, as they called it, of accounting. They wanted to have their stocks up and put out stories to do it so they could issue more stock. They were kind of chain letter arrangements. There've been a lot of bad conglomerates, and probably disproportionately so compared to sort of honest to God single industry businesses over time. We don't think we're that kind of a conglomerate. We've certainly never wanted to issue shares. We've never touted shares. And it's done for business reasons in our case. The interesting thing is, of course, is the American public has been going wild in their enthusiasm for conglomerates in the last few years, if you think about it. I mean, it's been an incredibly popular area, but they call them index funds. Oh. You buy 500 businesses.
Trying to figure out what you were talking
about. Yeah, well, 500 businesses all put together. I mean, that's the ultimate conglomerate, isn't it? I mean, I've recommended index funds to lots of people, and when they do it, they're buying into 500 businesses. And they're going to have 500 businesses a year from now and 5 years from now, and they think that group of businesses that will do very well, and I think our group of businesses will do okay.
The difference with an S&P 500 index is it's 500 different companies run by 500 different management teams who are all focused on their business, maybe not having a centralized operation that is loosely running all of those businesses.
Well, our businesses are run by separate people. I mean, we just finished Valentine's Day, and I did not select what pieces went in the boxes, and it's probably been 10 years at least since I've been to a See's Candy factory. Now, I get the figures every month, but I don't know how to make chocolate, anything of the sort. I don't pick out the new locations. We have managers for our businesses that are very much like the managers we have for the businesses that we own pieces of, like American Express or Coca-Cola. And there's a couple things we can do. We can determine the dividend policy of our subsidiaries. We can control their capital allocation to some extent, but on most capital allocation, whether to buy new equipment or anything like that, they make the decision. The BNSF Railroad is going to spend $3.5 billion on. I don't approve a single dollar of that in terms of capital expenditures. They know what they need to do, where they need to lay track, how many locomotives they need, whatever it may be. So our managers are, I would say, in a sense, they're almost more independent than the managers of the S&P 500 who go around and report to Wall Street week after week. They go to investor relations meeting, and they're always explaining what they're doing and trying to get the approval of the analysts and all that sort of thing. and we just tell our managers to do what makes sense.
Okay, outside of the idea of them not having to report to individual shareholders or the investment community, what's the advantage of having you there? The capital allocation part of it?
Well, we can move capital within. If you move capital from one stock to another, and you got a gain, particularly, I mean, you pay a tax, and may pay a dividend tax, or if you sell, but there's a lot of taxes incurred in moving from one business to another, either at the corporate level, in some cases, but certainly at the individual level. And we can move capital. Well, just take See's Candy again. We bought that in 1972. We've moved several $1 billion from the candy business to other types of businesses. And we'd love it if we could use it all in the candy business, but it just isn't that sort of business. And in addition to that, we free up our managers from all dealing with Wall Street, dealing with bankers, dealing with all kinds of things that are what I regard as less productive use of their time.
However, you also have a situation where you have gotten some activists who have been interested in the stock, including Bill Ackman. He's built up a stake, hasn't said too much about it, but I think he has made some comments about how maybe Burlington Northern Santa Fe's margins could be improved. You can look back at Bill Ackman's experience with the Canadian Pacific Railway and kind of wonder if he is building up a position because he would like to see you take a more active role there.
Well, we notice what other railroads earn and when their margins are better. I mean, and we certainly put way less pressure on than Wall Street might, who would want it next week. But our managers are well aware of what's going on in other industries, and we've made changes where we don't think some businesses are performing as well as they should. But overwhelmingly, we've got managers there that are very, very good. They've got capital available to them for anything that makes sense. And we decide how much they distribute, where the capital moves, and sometimes it moves from one industry to another. And in certain industries, a consolidated tax position really is very helpful to us.
There's a viewer question that came in from Ben Compston, and he asks, it was recently pointed out by Bill Ackman that some subsidiaries like Geico, BNSF, lag their peers in some areas. Would you agree with that? And how can your successor push improvement in subsidiaries while maintaining a decentralized management structure?
Well, at Geico, we bought control in 1995. We had about 2.5% of the market for auto insurance, and we're at about 13.7% of the market. So we've gone from $2.5 billion of premium volume or thereabouts to $35 billion of premium volume. We're number 2 now to State Farm. We were number 6 or 7 at that time. So I would say that not due to Berkshire at all, but due to Tony Nicely during almost all those years. Geico's been the envy of every other company in the auto insurance business except for Progressive, but they've done a good job too. But Geico is worth tens and tens and tens of billions more than when we bought it, in addition to all the earnings we've given, just the goodwill value. So that's been extraordinarily well run. And with Burlington, I think we paid a dividend of $5 billion last year, and we paid $35 billion for it. So it's gained in market share in its business. Its operating margins have improved, but they haven't improved as much as some other railroads.
Do you believe in precision scheduling railroading?
Well, we'll see. I mean, we've watched it plenty, and
for those who don't know what that is, it's something that kind of irritates customers because it makes things a little more rigid, but it does improve.
Yeah, it makes the customers adapt to the railroad more than the railroad adapting to the customers. And practically everybody's done it. And a fellow named Hunter Harrison was enormously successful.
Who worked with Bill Ackman at the Canadian Pacific.
Yeah, he worked for the BNSF, if you go back far enough. And there's a book about him. It's very interesting. But he did it at the Illinois Central, the Canadian National, the Canadian Pacific, and then he was going over to the CSX. He developed a method of railroading where the customer does adapt more to the railroad, and it improved margins dramatically. Our margins are close to what the better railroads, well, there's only a few, get from precision railroading. On the other hand, we've gained share
because the customers don't like
because the railroads apparently, or the railroad customers like us better. And over the long term, we'll see. But it isn't like it's something we can't do.
And here's the latest on the coronavirus. China reported an additional 150 deaths and 409 new cases overnight. South Korea raised its coronavirus alert to the highest level after the number of cases there ballooned from 31 to more than 750 in less than a week. Stocks in Asia falling overnight. Hong Kong's Hang Seng fell 1.8%. South Korea's Kospi fell nearly 3.9%. Shares of South Korea's two largest airlines down as they canceled flights to the city of Daegu, where many of the new cases were detected. Meantime, Italy's government is scrambling to deal with the biggest outbreak of the coronavirus outside of Asia. Stocks there were lower overnight. The government placed at least 10 towns in northern Italy under quarantine and canceled the last few days of the Venice Carnival. Elsewhere in Italy, schools, museums, universities, and cinemas were closed, and major soccer matches were canceled. At this point, I mean, Boris Johnson out earlier today, Andrew, saying that the risk to UK citizens just over there remains low. I would say that our officials would say that here too. The risk to the U.S. citizens remains low. But there's a significant difference between supply chain disruption slowing dozens and dozens and actually hundreds of companies.
Absolutely.
And that's dampening global growth. What worries me is that we don't know 3 months, 6 months, 9 months. If it ever gets to the point where we start to see, in a lot of countries around the world, these breakouts where they don't even know the origin of some of these, and if they multiply like that, that's when I think it could really get. At this point, it's still a global growth slowdown. Nobody in most of the world is worried that they're going to catch coronavirus, and they can't go out and they can't, go to the movies or the health club or to a restaurant. But that I just wonder. We don't know.
There are major travel that's being changed right now. Conferences are being canceled. There was an article in Time magazine speculating whether the Olympics in Japan over the summer will be canceled. So there's real implications here that could reverberate. Having said that, the farther we get to the spring, the better it gets in terms of weather. There's a whole sort of view about how the flu,
I was looking at some of Jim's tweets earlier. If you go too far with the fear and the panic, you're accused of one thing. If you don't go far enough, you're accused of the other thing. So we really just need to sit here and each day report on the facts and try to remain detached. But there's something about a pandemic that just is different than other black swans. It's a frightening prospect. Anyway, let's get right back to our guest of the morning. Warren Buffett joins Becky in Omaha following the release of his annual letter to shareholders over the weekend. Becky, you took a plane. I mean, it's in the back of our minds, is it not? It's just in the back. There's no way. And the risks are low.
So it goes back to 1918. It goes back to 1980. If you look at the numbers of what happened in that pandemic when it came around the globe, up to 50 million people were killed in that. It was a third of the planet's population that was infected. It was 500 million people that were infected at that point. 675,000 Americans died at that point. So inevitably, your mind kind of goes back to what's happened in the past, because as humans, we always look back to history to try and predict the future. It doesn't always work. It's not always prophetic, but it does give you something of what to kind of play out if this were to get worse and worse. Now, Andrew brought up the idea that it's warm weather. We're approaching spring in a lot of parts of the country, or a lot of parts of the planet. That may be good news. We just don't know if this time around, if this is one of those viruses that does die off in warmer weather. Wait and see and kind of hope.
Yeah, actually, I think this, from what I've heard from people that know a lot more about viruses than I do, that unfortunately this will make it through the summer, and in terms of having a vaccine, it's a long ways off. So. You've got, it is scary stuff. I don't think it should affect what you do in stocks, but in terms of the human race, it's scary stuff when you have a pandemic.
Yeah, I guess this one's particularly frightening because it's new. So there's no natural immunity that's built up in any of the populations, and you wonder what happens, particularly in areas where there's not the same healthcare structure that we have in America or in some of the developed nations. I guess that's a big part of the question too.
Yeah. And well, I think about it in terms of our annual meeting. I mean, which is May 2nd. I mean, it could very well affect, by that time, it could affect.
We got questions from viewers asking just that. Will the annual meeting be any different this year, particularly because you have a large Chinese contingency of shareholders who come here for that?
Yeah, and that certainly will be affected. And incidentally, I mean, flu is particularly tough on old people. If you're going to have two guys on the stage whose combined age is 185, so we won't be looking for people that are showing any signs of contagion. But that's one of the problems with this, is it does have a long gestation period,
Right.
And it's highly transmissible.
And again, you did talk about it earlier. It's something that you see in the results of the businesses, even
true.
some of your own fully owned
Sure.
businesses that you didn't anticipate.
Well, and we own airlines, for example. No, it affects businesses. Now, actually, my dad used to tell me stories. He was 14 in 1918, and he told me what went on in Omaha, during the big Spanish flu epidemic. I mean, it was something in those days, and pandemics will occur in the future. Now, what they hope to get is a universal flu vaccine, but that's a long way off. It isn't impossible. I mean, I asked my own science advisor is Bill Gates, so I talked to him. I call him. I've talked to him the last few days about it, and he's bullish on the long-term outlook for a universal prevention of it. But he says it's not going to come, it's not going to be here in 10 years.
What are Bill's concerns as somebody who spends a lot of time traveling around the globe, as somebody who is trying to help medicine in some of the less developed parts of the world?
Yeah, the Gates Foundation is very active in trying to be helpful on this, and Bill says the CDC is the best in the world, and I mean, we've got terrific resources in this country, but a pandemic is a pandemic, and there's just no evaluating. But I have heard that the summer is not likely to cause the end of this.
Do you know why?
But I don't know, and you shouldn't be asking. I shouldn't be offering my opinion on that, because I pass along things I hear from people I think are smart, but
I'm actually asking for Bill's opinion, not yours.
yeah, well, I shouldn't really quote him, but I do. He's the guy I ask, and I did talk to him just a few days ago, and he loves to talk science, and he can make it so I can understand it, which is quite a trick. At the Gates Foundation, they're taking it very seriously. I'll put it that way.
Is money going from the Gates Foundation to try and find a vaccine?
I'm sure we're expending human and financial resources.
I mean, maybe this is more than you know, but do you know if they have put human resources out either into China or other places where there's...
I don't know that. I don't want to comment on that, but I know that that is something they've always spent. They've been very involved in is human health, and even particularly this. Bill knows a lot about vaccines.
Okay. Let's talk a little bit about Berkshire Hathaway. We were in the middle of a conversation when we had to go to a break before, but there has been this question raised, not only by Barron's in the cover story there, but by other places too, about whether Berkshire Hathaway would be worth more if it were split up.
It's a good question, and I will tell you that if you were to say, and let's say the stock market didn't change for 2 years and interest rates didn't change, so you had a 2-year period and you said, we'll sell off all the businesses. Mm-hmm. I don't think, I mean, you have the expenses of selling them. Now, if you sold them all to people who leveraged them up to their maximum, you might get a little more than the stock is selling for. It would be very tax inefficient, very tax inefficient. Interestingly enough, up till 1986, it wouldn't have been. I mean, there was a general utilities doctrine that governed corporate breakups, and so you could dispose of businesses or securities if you did it right. You could dispose of securities or businesses that had appreciated without a tax at the corporate level. That was done regularly in various ways up till 1986. They revised the tax code big time. They killed general utilities. You can't do that now. Now you can have spin-offs, this business or that business. You probably have to lie a little in terms of your purpose in order to get the best tax ruling. And it takes time, but you cannot you cannot dispose of the entire business, business by business, without having very substantial tax liability. It would not produce a gain. On the other hand, having them together produces, there's some very valuable synergies in there. Now, we don't use leverage as much as the people who would buy them piece by piece would do. So we could leverage Berkshire up to the sky. I've promised people we won't, because we have insurance promises to people out 50 or 100 years, and we've got shareholders who are going to own the stock for 50 years, and they do not want us to leverage to the sky. But there would not be a profit if we were simply to announce that over the next 24 months that you could come in and buy any business we had and we'd sell them to the highest bidder.
You made a point of talking about this in the annual letter. You said, key to my Berkshire-only institutions is my faith in the future judgment and fidelity of Berkshire directors. They will regularly be tested by Wall Streeters bearing fees. At many companies, these super salesmen might win. I do not, however, expect this to happen.
That's exactly true. And I think by writing it, it helps it a little too. No, there's no question that Wall Street would love to come along and sell anything that we've got. I mean, there's a fee every time that there's a transaction, and they're big fees, and there's fees for financing. I mean, so we've had all kinds of people snoop around that. They know they're not getting it done with me, but it won't get done later on either. I am leaving every share of Berkshire I have goes to charity, and it's 99% of my net worth. So nobody cares more than I do about getting the most money to those philanthropies over the years following my death. And that's going to take place over 15 years. And I say keep it all in Berkshire. But if I thought that it was going to be run in a way responsive to Wall Street, I would instead do something else and have the money distributed to these philanthropies and not have it all tied to Berkshire. But Berkshire has a very unusual shareholder base. I mean, we have individuals that own Berkshire, and a lot of them have owned it 50 years just like it's people buy it to own for lifetime, and we're going to run it in a way that they won't be disappointed.
Do you think the people who are relatively newer shareholders buying the B shares have the same mentality as the people who have been in it for 50 years in the A?
Well, we try to,
shares?
Because that's who we encourage. I mean, in effect, we don't want everybody to buy our stock. I mean, there's only so many seats. There's about 1,600,000 and some thousand A shares out. All the seats are filled. I love the shareholders we have. I don't want to go to Wall Street and try and get some new shareholders. They're going to replace the people we have. So what we want to have is people in those seats that are in sync with us. You can run a French restaurant or you can run a hamburger stand. And if you serve good hamburgers, you'll do good business at the hamburger stand. You can, at the French restaurant, you can do the same thing there. But you can't run the French restaurant and then serve hamburgers inside. And you can't run the hamburger stand and serve French food inside. So we advertise in our deeds, in our words, in every way we can what we're about. And we're looking to have the seats filled in our church by people who are in sync with us. And we do have them there. We get the same people every Sunday. And I see no advantage in going out and telling everybody in Wall Street we're going to do wonderful things and having those seats replaced, because the only way you can get a seat is to throw somebody else out of that seat. There's only so many seats and they're all full. And you want them filled with people who are in sync with the policies of the company. And therefore you have to explain those policies, and you have to live up to those policies, and for 55 years we've tried to.
So you get the shareholders you deserve.
Exactly.
All right, not to mix metaphors, but can you have a decentralized central office running both the French restaurant and the hamburger place?
Well, we're not trying to have the railroad management run the utility or anything.
No, decentralized, that's what I mean. A decentralized headquarters that's in charge, a conglomerate in charge of all those different businesses.
Well, we could run. Well, we have decentralized management as it is. We could have somebody in charge of all the little companies, another one for the big. I mean, we could divisionalize it in all kinds of ways. I think we'd have more overhead. I think we'd have a different sort of manager. Our managers like running their own businesses, and they never have to finance their businesses. I mean, they never have to go to Wall Street. They probably save 25% of their time, and I want them feel they own their businesses, and that's all they're responsible for. If we mess up some other way, they get paid based on how they do, and there again, we attract managers who like to operate on that basis. We don't attract managers, particularly who think they're going to keep moving step by step through various divisions and eventually run the whole place.
One of the things that people wrote in, a lot of people had questions about the banks, about what's happening with the banks, what you've changed with some of your investments over time. Jason Goldberg writes in, he says, please ask Warren about his views on the bank stocks in general and on Wells Fargo in particular. Over the last 2 quarters, he sold almost a quarter of his longstanding Wells Fargo stake. Also in the fourth quarter, he dumped a third of his Goldman Sachs shares, although he still owns over $75 billion in bank equities. So what do you think about banks? Not necessarily the sell-off today because you don't look at day by day.
Well, banking is a good business if you don't do dumb things on the asset side. I mean, basically. And it's a business that the banks we own earn between, the commercial banks earn between 12% and 16% or so on net tangible assets. That's a good business. It's a fantastic business against the long-term bond, at 2%. If you have a choice between a 2% instrument and a 12% instrument, which one's going to win over time? So if you ask me whether I think banks are going to go down where they only earn 3 or 4% on tangible assets, I don't think that'll happen. The question is really whether they do something massively dumb. I mean, which periodically a number of banks have done, and I feel very good about the banks we own. They're very attractive compared to most other securities I see, and most of them are buying. Bank of America is buying in a lot of stock every year. So our ownership of the Bank of America this year probably will go up 7 or 8% without us spending a dime. I'd like to own any business, any good business where my ownership just goes up 7 or 8% every year without me spending any money, and on top of it, I get a dividend and so on. They're very attractive, both against interest rates and against against bonds and against other stocks, in my view.
You say occasionally they do dumb things. Maybe you're talking about Wells Fargo with the scandal that it had. It just settled on Friday with a number of the regulatory institutions that were kind of looking into it, the investigations that were taking place for $3 billion.
Yeah.
Does this mean that they have kind of finally gotten through that and can move forward?
I don't know the answer to that. I know that they paid $3 billion because it was announced. I don't know what else is outstanding. But Wells Fargo is classic in terms of one lesson. My partner, Charlie Munger, he says, whenever we have a problem, you attack it immediately. He says an ounce of prevention is not worth a pound of cure. An ounce of prevention is worth a ton of cure. And we've seen that time after time. And the interesting thing, and I don't know the details at all, but the original thing was a whole bunch of phony accounts. Now, I don't know how, if you open up a couple million phony accounts, you make any money on it at all. I mean, the shareholders didn't make money. People say that, well,
the incentive structure was set up so that some of the employees
didn't make money. It was the dumbest incentive system you can think. And as soon as you learn, you can devise dumb incentive systems. We've done them ourselves. I mean, you can cause people to do the wrong thing because they will do what they're incented to do. And they had obviously a very dumb incentive system. People started playing it in various ways. And the big thing is they ignored it when they found out about it. I mean, you're going to do dumb things in business, and we do them every day, But you absolutely have to attack a problem as soon as it occurs, and you know about it. And if that had happened, Wells Fargo shareholders would be a lot better off. But Wells Fargo shareholders did not profit from opening up accounts that were phony accounts that had nothing in them. I mean, somebody was getting paid so much per account. And the practice spread because bad practices do spread if they're allowed to spread. And they were ignored, which is a total disaster. And look at the consequences. So 2 or 3 years later, who's paying? The shareholders are paying for something that didn't do them any good whatsoever.
Is that why you've sold off some of the shares?
No, not specifically.
I know you don't want to get specific on why.
Yeah, no,
you
I'm not recommending it. It's what stocks, people have to make up their own minds on that. But
Okay. I want to ask you a question about Todd Combs and his new role at Geico. I got several questions that came in from that, and let's just use this one from Peter Lampras. During last year's interview on CNBC, after the 2018 letter was released, you were asked about succession at Geico, and you mentioned that at a recent meeting at Geico, you met about 40 of their top executives, and after each introduced themselves, they stated their length of time with the company. The shortest was 19 years. Please explain why none of these 40 top executives were qualified to take over as CEO after the retirement of Bill Roberts. Again, that's Pete Lampras from Chicago.
yeah, Bill Roberts took over not even 2 years ago. And he has done a terrific job in connection with Tony Nicely. I mean, Geico is my first love, absolutely. I tell the other companies that you can compete for my second love, but you can't compete for my first love, which is Geico, because it goes back 69 years, and it did wonders for me. Anyway, Geico, Bill Roberts took over a little less than 2 years ago, and then in either October or November last year, he said he'd like to retire in a year. He would adjust it in any way that made it the easiest for us. And we did not have the person, in my view, to replace him at that point. And Todd Combs, who's worked with Berkshire now for 10 years, he actually was a product manager at Progressive in the past, and he knows a lot about insurance. Insurance is probably the only business I know something about that we're in. All the rest of them are total confusion. But I understand the insurance business to some degree. Todd understands it very well at the operating level. And so Todd is there, and I hope very much that he's not there very long, because I'd like to get him back to Omaha. But our intention always is to promote from within, and we would hope to pick out the right person at Geico. It isn't that there isn't somebody there, it's just you want to have the right one, because when you put somebody in, you're going to keep them there for a long time, and or her. And
does that suggest Todd is not going to be there for a long time?
I don't think he's going to. No, the plan is not for him to be. I mean, he has not made a permanent career shift, he, I don't know how long he'll be there. We have one important problem, which is which all insurance companies have, but Progressive has done a better job of managing correlating or risk with rate, and that is what we're focused on now.
Correlating risk with rate.
In other words, having the proper rate.
Right, charging the right amount.
Charging the right amount. If you were in the life insurance and you thought that 80-year-olds had the same life expectancy as 20-year-olds, you'd have a big problem. And what would happen is you'd write all the 80-year-olds and somebody would write all the 20-year-olds. So in auto insurance, the same thing. There's a vast difference.
In auto insurance, I'm not sure. I might prefer the 80-year-olds over the 20-year-olds.
Well, you might, and you certainly would prefer the 80-year-olds to the 16-year-olds. I mean, right. And you'd prefer the 16-year-old female to the 16-year-old male. There's a whole bunch of things. So you've got to you really got to segment risks, and that's enormously important. And every company's trying to do it better all the time. We do it far better than we did 50 years ago, but we have room for improvement on that. We're focused on that. And in the meantime, we're growing faster. We're gaining market share. Geico is a fantastic asset. Todd's job is to focus on that, but it's also to work himself out of a job very, very quickly, and preferably to work himself out of a job with somebody from Geico.
Eric Lafont writes a follow-up question. He says, Warren, why did you and Ajit decide to appoint Todd Combs as the CEO of Geico? That part you've answered, but how will he be able to run Geico, manage a $13 billion investment portfolio, oversee Haven, and be on the board of JP Morgan?
Yeah, well, it'll keep him busy, and we've told him he's unlimited use of a NetJets.
Really?
Oh, sure. No, I mean, we want him to be efficient. That's what NetJets is for, and he, he'll be working 70-hour weeks. The question about the portfolio is interesting. Most months, neither Ted nor Todd makes a single change in their portfolio. I mean, portfolio management is something that you learn over decades. And when I ran Solomon, I was running Berkshire's portfolio. It is not something that you have to sit there day by day and do. People do it that way, but if there are many years where if I just left the portfolio entirely the same and didn't make any changes, we'd be better off. So that's not about. But you're right in terms of J.P. Morgan's board, and he's going to be a very busy guy. Geico's the top priority, but it isn't going to stay the top priority for a long, long time.
All right, let me run to another question that Max 0205 wrote in. Have Todd Combs and Ted Weschler outperformed the S&P 500 since they began working at Berkshire? Why don't you disclose their record?
Why don't I?
Why don't you disclose their record, they said.
Well, we're not disclosing. I think it would be very unusual for a firm to disclose everybody's sales last year among their salespeople or anything like that. I mean, they're entitled to work in relative anonymity. Our directors know how they do. I know how they do. We made a lot of money with them. I feel very good. I feel very good about them in all ways. But we're not going to tell you how much each candy store sells. It's See's Candy, or who was the top person at any place brought in sales, or whatever it may be.
All right, let's jump to Berkshire's overall record versus the S&P. Berkshire has now underperformed the S&P 500 on 1-year, 3-year, 5-year, and 10-year marks.
Yep.
Is that because it's too big, and will it ever be able to outperform the
Well,
S&P?
certainly being too big is part of it. But I would say this. During that same time, I mean, last year, we achieved, now I don't like it, GAAP earnings very well, but we achieved the highest GAAP earnings of any company in the world has ever achieved that's investor-owned. And we have the highest net worth of any company in the world, investor-owned, any company in the world. So I would say, related to safety of principal over time, I feel good about it. And I feel good about the fact that 99% of my money's in it, and that it will be the source of all the philanthropic contributions that are made for 15 or dozen years after I die. So, but I do not think it will be in the top 10% of stocks performing over the next 10 years. I don't think it'll be in the top 15% of stocks performing in the next 10 or 15 years. I also don't think it'll be in the bottom 10% or 20% or 30%. So, but our ability to have a huge edge over the market generally with a $550 billion market value, it's just, it'll be minor, but it'll be done in a very, very safe manner.
Is an investment in the S&P 500 a better investment than Berkshire?
It could be. On balance, I think we'll do a little better, but it'll be minor. It depends on the kind of market we're in. If we're in a down market, we're going to beat it. I mean, that's simple. And sometimes we will be. The last 10 years we haven't been. But over 55 years it's worked, and it will continue working, but it will not work at all like it did when we were working with $100 million or $1 billion. There's no question about that. But we've got good businesses, and we won't be in the bottom quartile, I promise you that, over any long period of time.
There are people, like there were back in 1999, who have said maybe you've lost your edge. It was a similar thing in 1999 where you saw the technology stocks that were the big high flyers that people were pouring their money into, the dot-com companies and a lot of others associated with that. If you look at the markets again, it's the technology companies that have the big runs. This time you're participating in Apple, which is one of those front runners. But is this a cyclical thing to you? You think there'll be another market downturn and then Berkshire
there'll be a downturn sometime.
And then Berkshire outperforms at that point, or?
Oh, we'll outperform in a down market, but that may not be particularly satisfactory to people. But no, we will, because we have these businesses that are making money, and I mean we're geared somewhat away from a full market participation in either direction. But that's fine. We own, if you think about it, we're 80-some% in equities. We may show 230 or 40 billion in equities, and that looks like we're against our market cap we're 40%, but we own 100% of these other businesses. Those are equities too. I mean, we own a railroad, and we own insurance companies, and those are equities. So we're about 80% roughly in equities and about 20% in cash. And I'd rather have that 20% in other good businesses. But that is to some extent a curse of size, and it's to some extent the fact that it's very hard. If interest rates stay at this level, we'll wish for the next 10 or 20 years, we'll wish we'd been 125% in equities. I mean, equities are so much cheaper than bonds, long bonds, that something will change in a major way. I just don't know what. And I want to be prepared for anything, obviously.
So that's why you keep so much cash around. You want to be able to be prepared for a downturn. You want to be prepared for a crisis.
We want to be prepared for anything, Becky. We want to be prepared for pandemics. We want to be prepared for anything comes along. Yeah, that is the chief job I have. I have people's money that gave it to me 50 or 60 years ago, and some of them still have 100% of their money are essentially in it. And the one thing. And I've got the responsibility for 5 foundations that presently are going to get $80 billion, and I think we'll get a lot more over time, probably. We don't want to permanently lose money, and you don't want to get that so that you go into a shell and don't do anything. But we have obligations to people on workers' compensation claims and auto accidents they've had that go out 50 years, and we have to run the place so that every check clears under any circumstances. And that's why, incidentally, we own treasury bills. We don't own commercial paper. We don't rely on bank lines or anything. When people get terrified, and they will occasionally, everything freezes. I mean, and you're going to have to stand on your own feet at a time like that. It won't happen very often, but it'll happen occasionally.
I know you've developed a thick skin over the years, but does it tick you off when people start questioning whether you've lost it, whether you can still?
Well, I'm sure I've lost some of it. I mean, I can tell you all kinds of things I've lost. No, that happens. But we haven't lost Geico or the railroads we own. Berkshire, without me, is worth essentially the same as Berkshire with me. I mean, my value added is not high, but I don't think I'm subtracting value, but the big thing is how our businesses do and what we get to add in the way of businesses over time. And we can add them through marketable securities. I mean, we own 5.5% or a little over of Apple. It's probably the best business I know in the world. And we own 5.5% of it. And that is a bigger commitment that we have in anything except insurance and the railroad. So it's our 3rd largest business.
Yeah, it made the point that it was bigger than your biggest acquisition, Precision Casualty.
Oh, sure. No, it's our 3rd largest business.
All right, let me test you on your thick skin.
Okay. Wow.
Here was the kicker of that Barron's cover story. He said, there's reasons to think that the company will be a market beater when he's gone. In the meantime, happy 90th.
Yeah, well, I hope it is a market beater when I'm gone. I'm counting on it. I'm telling my estate, and then the trustees that succeed my executors in the estate, I'm telling them to keep every share of Berkshire they have until they have this pattern of giving it away. I mean, I want them to look back and say, gee, we should have made this change earlier, because it's going to determine how much we buy in the way of vaccines and all kinds of things, education, and all these things. And I feel terrific about Berkshire after I leave.
I want to talk about another issue that we have not touched on yet, and that's politics here in the United States. We just watched the Nevada caucus. Bernie Sanders walked away with the most delegates after that. He looks to be as the clear frontrunner for the nomination for the Democrats this time around. You have long been a supporter of the Democratic Party. What do you think?
Well, I think I'm going to wait and see who gets the nomination. But I'm a Democrat, but I'm not a card-carrying Democrat. And I've voted for Republicans. I've contributed to Republicans. In fact, I've only run for 2 offices in my life. One was head of the Young Republicans at the University of Pennsylvania, and the other time I was actually on the ballot running for a delegate to the Republican National Convention in 1960. But normally I vote for Democrats, and we will see what happens.
Wow, that's the first time I've ever heard you say something like that.
Well, I've kept it a secret for all these years, but now it comes out.
You just said that you're not a card-carrying Democrat.
That's true.
You are a card-carrying capitalist. You
Absolutely.
actually have one of those in your wallet.
Yeah.
I've seen it.
I don't know whether I'm a card-carrying capitalist, right? I don't think that's inconsistent with what I've said on politics. Yeah, here it is. I don't know whether that
For
shows.
those who can't see, I'll show you on this camera right here.
Card-carrying capitalist, and
This is what you carry in your wallet.
yeah, and I think we will have some of those available at the annual meeting too for our shareholders.
I think Andrew's got a question that he wanted to jump in with here. Andrew?
I was just going to follow up on that question, Warren, which was about a year ago. We had asked you about Michael Bloomberg, and you had said that if he ever entered the race, he was somebody you would support. Would you support him? Is he your candidate?
Well, I would certainly vote for him. I don't think another billionaire supporting him would be the best thing to announce. But sure, I would have no trouble voting for Mike Bloomberg.
And what do you think his chances
are? And incidentally, well, I don't think I want to get into handicapping the race, but I would say this in terms of Sanders. I actually agree with him in terms of certain things he would like to accomplish. I don't agree with him in many ways, but in terms of the fact that we ought to do better by the people that get left behind by our capitalist system. I don't think we should kill the capitalist system in the process. I think we should make sure that the golden goose keeps laying more eggs, and it's worked wonderfully since 1776. But it doesn't work as well for people whose talents aren't really geared to a market economy. And I don't think anybody should be left behind by an economy that has over $60,000 of GDP per capita. And so I'm a big fan of increasing the earned income tax credit. And I think there should be some changes made. But if given a choice, I would certainly vote for Mike Bloomberg.
There is a plan. Let's talk about some of Sanders' plans. You said you agree with some of what his intentions are, but let's talk about some of those actual plans. One of those plans would be to give 20% of company stock to employees and put workers on the board. What do you think about that? That would be for any company, public company, that has more than $100 million in annual revenue or a $100 million balance sheet.
Well, I don't want to get involved in evaluating his whole plan, but I think that would be a particularly bad idea.
Because?
Well, I don't think that I don't think putting 20% of the capitalists on a labor union is a good idea either. And I think the market system works very, very well in terms of developing more goods and services. I mean, when you flew out here to Omaha, if you'd flown out here and you wouldn't have been able to fly in 1776, you wouldn't have seen anything. Everything you see is the product of a system that's worked like nothing's ever worked in the history of the world. So I do not believe in messing up our system of developing output. I do believe that anybody's willing to work 40 hours a week and has a couple kids should not have to have a second job. And I believe in having a higher income per people, not necessarily a higher minimum wage, but I do not think it's at all unreasonable that the income tax credit produces at least $15 an hour, maybe higher in certain areas. So I'm very much in sympathy with the fact that Senator Sanders believes that a lot of people are getting left behind and through no fault of their own. And there's all kinds of aspects of capitalism that can need, in some ways, to be regulated. But I don't believe in giving up the capitalistic system.
All right, let me slip in some questions that viewers have written in on this front. Michael Blank writes in, please ask Warren if he thinks the market will sell off if it becomes clear that Bernie Sanders will win the Democratic nomination.
Jack Mislis NA 190 Paul Gulepsi BYLBY Dodge CZY Cos Inigo NA Gluth Bandi Tash.
That if you had Sanders and a Democratic House and Senate.
Bozo Stalomi 130 Dudabishia I Misl Jockey Charm Naj Lepsi BYLBY.
There would be a significant difference, but I don't think I would necessarily vote on what, in fact, I know I wouldn't vote on what I thought necessarily would affect the market the better. I think it's a very poor yardstick. I would not want to cast my vote in a presidential election based on which would be better for the market in the next 30 or 60 or 90 days after the election.
But your reservations with Bernie Sanders, I assume, come with your concerns about what it means for the economy, not over 30, 60, 90 days, over a much broader period of
certain
time.
aspects of the economy. Certain things, I'd like to see done. I would like to see the earned income tax credit change dramatically upward.
Alan Buckey writes in a letter, he says, if Michael Bloomberg becomes the Democratic candidate, would you consider buying his company?
No. I can give you a categorical answer to that.
Because of the price, because of the...
There'd be somebody who'd pay more.
Warren, we've talked this morning about the coronavirus, but there are people who are waking up across the country now, kind of tuning in at this hour. So maybe we should address this again. With the markets indicated down 750 points, with concerns about coronavirus spreading and now worries about what that will mean for the global economy this year. I know this is not something you look at a day-by-day basis, but how do you kind of wake up and read this and think through it?
I don't think it makes no difference in our investments. I mean, there's always going to be some news, good or bad, every day. In fact, if you go back and read all the papers for the last 50 years, probably most of the headlines tend to be bad. But if you look at what happens to the economy, most of the things are extremely good. I mean, it's incredible what will happen over time. So if somebody came and told me that the global growth rate was going to be down 1% instead of 0.1%, I'd still buy stocks if I like the business and I like the price at which and I like the prices better today than I liked them last Friday.
Do you like prices better today? Will Berkshire be buying stock today?
Well, we'll certainly be more inclined to buy stock today than on Friday. Yeah. Anything we were buying Friday, we will be buying today, and feeling better about buying it.
You know, one of the things you talked about in the annual letter was stock buybacks of Berkshire Hathaway.
Right.
And for the first time, you told people to call Mark Millard in your office outright if they have $20 million worth of Berkshire shares, and they're ready to sell. Right. That's a really unusual move. Why did you do that?
Well, we did it because it's very hard to buy blocks in the market of Berkshire. We practically never see blocks, except we do see them from estates or occasionally. But if somebody's going to sell $100 million worth of Berkshire, and we want to buy it, we'd like them to call us, and if we're buying at that price level, we'll buy it.
Dan Mahoney actually wrote in with a very similar question. He just said, "Is it hard to buy back the shares?"
Yeah, it's harder to buy back Berkshire shares than, say, Bank of America is buying back their shares. Bank of America bought back 8 or 9% of their stock last year, and they can really do it without moving the market. I mean, Apple's been buying back a ton of stock. They were buying stock at the same time we were buying stock. But it was easier for us to buy Apple stock, even though Apple itself was buying a lot of stock, than it is to buy Berkshire. Berkshire is, well, it's held by people that really plan to keep it. I think the amount of speculation in Berkshire stock is relatively low compared to most stocks. And so well, we bought $5 billion worth last year, but that's only 1% of the market cap. And I would say with a great many companies, you can buy 4 or 5% of the company fairly easily a year without disturbing the market. American Express has been buying it every year.
So with you putting out an ad in the letter to shareholders, does that basically mean you are eager to buy more shares back?
Depends on the price, but we'll let anybody know if we told them to call us before the opening or after the close, and only with blocks, and only if they're ready to do business. Now, there'll be a few people that probably try and call just to see whether we're buying or not. And we will not show a lot of patience with those people.
Let's talk about shares of Apple. Both from you just mentioning it with the share buybacks, with it being such a huge holding of yours. You've got more than 5.3% of the company right now?
Yeah, I think it's 5.6, but
5.6%,
and it goes up every day.
Let's talk about what
buying.
we've seen with the slowdown with the coronavirus, because Apple is one of the companies that has said it's going to have an impact, not only with the stores that they've closed there, with the behavior of Chinese customers, but also what happens with the supply chain.
Supply chain, sure.
How do you read through any of that? What are you hearing? Do you know more than we do on that front?
No, I don't know one thing more. I may see Tim Cook at the annual meeting. I see him in Sun Valley once a year. No, I don't think I've placed a phone call to Tim Cook in 2 or 3 years. All all kinds of things are going to happen to Apple over the next 10 years. The real question is, what is the degree of pervasiveness and strength of that product 5 or 10 years from now? And I don't think of Apple as a stock. I think it's our third largest business.
It's also a high-flying technology company. It's one that's been at the forefront, but you've said in the past you didn't buy it because it's a technology company.
I think it's a consumer product. In fact, I think I said this on the program a couple of years ago. I mean, it is, obviously it's a consumer product company that uses technology, but we've got a lot of products that use technology at Berkshire. But it's an incredible company. and I should have appreciated it earlier.
There's a question that came in from, I guess the handle is GPG. This is a question that came in on Twitter, and the writer asks, you've said that you can do fair value estimates of companies you follow at any time in your head. So please do one now for Apple. What went wrong with your estimate for IBM, and how is that miscalculation different than for Apple?
IBM's an entirely different business than Apple. I mean, Apple doesn't resemble IBM anymore. It resembles See's Candy in a way more. I mean, it is a incredibly useful product to people that grows more useful as the number of people are involved. I mean, it's really interesting. You know, we call them smartphones. If you go back and look at the old telephone, that was an incredible, useful product. It changed my mother's life and my dad's life. It changed lives in every way, and they took a long time to become pervasive, and it was very expensive initially, but it changed the world. And the smartphone is part of hundreds and hundreds of millions of people's lives in all aspects of their lives. It's used as all kinds of utility. It's a consumer product.
Are you a consumer of its products at this point? You've had a flip phone for forever.
I'm glad you brought that up. I am now using, not very often, but I'm using the latest model, and I'll give you a little preview of our movie for the annual meeting. We haven't done it yet, but it will probably show me crushing with my foot my old flip phone while cozying up to the new smartphone.
When did you get the smartphone?
I've been given several of them, but including by Tim Cook.
One finally stuck?
What, pardon me?
One finally stuck? You're actually
yeah, absolutely. No, my flip phone is permanently gone. The number's been changed to my new phone. Wow. Yeah.
That's impressive.
I mean, you're looking at an 89-year-old guy that's barely beginning to be with it.
What do you like best about the phone? And what do you like least?
Well, I don't use all its facilities like most people. I mean, most people are living their lives around it, and I use it as a phone.
As a phone and nothing
else. I
use
it as a phone.
I don't like it when investment bankers talk about EBITDA, which I translate as earnings.
That was Berkshire Hathaway Vice Chairman Charlie Munger about a week and a half ago when he was speaking at the annual shareholders meeting for his other company, the Daily Journal, answering questions, giving his usual straight answers when things come up as questions. Warren, that was Charlie talking about EBITDA earnings, calling them BS earnings, although he said it a little more explicitly. You, in your shareholder letter for Berkshire Hathaway, also wrote about how you don't believe in GAAP earnings. How do you guys come about this? What do you think? You still have to report these numbers, but you're basically telling shareholders don't listen to them.
Well, it's two different principles. I mean, the GAAP numbers, which show us earning $80 billion, which is more than any company's ever earned in history. And we explain why that really isn't the relevant statistic, because a lot of that was just the stock market going up, which now gets counted in our earnings. And Charlie was expressing
Cycle W jockey spazib.
Charlie's one of the pair, but Charlie is the best partner anybody could possibly have. We've been partners now for 60 years, and you could not have a better partner. He, at 96, a woman, since that meeting actually, in the last couple of weeks, a woman said to him, "Is it true Mr. Munger, that you have 8 children, and Charlie's reply was, so far. So Charlie is very much an active partner, we'll put it that way. Next time I see him, I'll get an update on that to see what so far still
Yeah,
going.
okay, let us know what happens with
Yeah, I will.
You know, we watch pretty closely Charlie's shareholder meeting for the Daily Journal.
Sure.
We send cameras out, we watch it. I've been out myself. Do you watch that meeting too to see what he has to say?
I watched it all on YouTube afterwards, but my sister and one of my good friends and my niece were all there, and no, I end up watching it, and I actually end up reading it usually too. I wouldn't miss it, but I don't go out for it.
Was there anything he said that surprised you this time around? And I'm just looking through some of his.
Actually, nothing
sound
Charlie
bites.
says can surprise me.
Was there anything that enlightened you or changed your opinion on something? Maybe something.
No,
that you thought
but I learn from Charlie every time I talk to him. Charlie has the best 30-second mind in the world, so I can go to him with a new question, a new problem of any kind, and it goes through about 8 filters in his mind in 10 seconds, and he gets to the essence of any problem. There is nobody better to talk to than Charlie at age 96.
Is there anything you've talked to him about recently that you might be able to share? I don't know if you want to share the conversations you guys have privately, but anything where you've bounced something off of him and he.
Well, we talk about a lot of things, and we talk particularly about things we don't know the answer to, and you know, we find the whole scene so interesting, whether it's politically or economically or the world. I mean, it's incredibly interesting to us, and we're particularly interested in each other's view, although I think I'm more interested in his view than he is in mine. And that would be a correct decision to make for somebody overhearing us.
What's something you guys don't understand right now?
Oh, we do not understand at all what the outcome will be in a world where 13 trillion is being borrowed at less than zero, and even Greece went on short-term. I think Greece, the 10-year bond is 1%, for example, and at the same time, in this country, we're having, under very good business and market conditions, we're having a 4.5% federal deficit, and nobody is concerned in the least. And we're talking about massive new programs and so on. Everybody talks about how they'll pay for them, but they really, you know, the deficit's going to widen. So we don't know what world comes out of something where you start with extremely low interest rates and high rates of growth, and then what you do for stimulus later on. But the whole game, I mean, the game always unfolds differently than you expect, and that's what makes it so interesting.
You know, the 10-year, speaking of these low rates, just a little bit ago hit its lowest yield since July of 2016 this morning. I think it was 1.377%. We're back at 1.396%. But 10-year rates below 1.4%.
Yeah.
Would you have anticipated this?
It makes no sense to lend money at 1.4% to the U.S. government when it's government policy to change to have 2% a year inflation. I mean, you've got the government is telling you we're going to give you 1.4% and tax you on it, and on the other hand, we're going to presumably devalue that money at 2% a year. So these are very unusual conditions, and classical economics, it doesn't appear that, you know, what do people do under such circumstances? Does everybody buy a mattress and stick their money under the mattress or what? And it particularly seems unusual when the world is generally prosperous, and you know, but the game is always changing, but it always looks logical in retrospect, and it always looks puzzling prospectively. But there's always things to do that make sense too.
Like what?
Well, I hope that's what we're doing. It's buying good businesses at decent prices, whether all of the businesses or parts of the businesses through the stock market.
You know, you told me a year and a half ago, maybe longer, that when you went out to try and buy whole businesses right now, it just looks too expensive, which is why you started buying pieces of companies, more stocks, putting money in places like Apple. Is that still the case? Is it still a huge premium to try and buy a company outright?
There's quite a premium, and part of the premium is because you can borrow so much money so cheaply in buying those businesses. Obviously, you can pay more for a business if you can borrow a very high percentage of the purchase price and of the future cash flow committed to it, and you can borrow at low rates with very little in the way of restrictions, restrictive covenants or anything of the sort. I mean, that's going to bring higher prices, and the demand for that is huge, and people look at those rates on the 30-year or the 10-year, and they say to themselves, gee, I can't live on that, and so they stretch and buy poorer credits. But that's just part of the human cycle over time, and that leads to something else, and that leads to something else. In the end, if you own good businesses at the right price, you're going to do fine.
You're often quoted as saying that you don't know who's skinny dipping until the tide goes out, who's swimming naked until the tide goes out, whatever it may be. You get the sense with a high tide right now that there's a lot of skinny dipping taking place?
We're certainly we're allowing people to borrow money on much weaker terms than we were 5 or 10 years ago. You couldn't borrow money at all there for a period of 10 years ago. I mean, you literally, Berkshire couldn't borrow money. I mean, everything stopped. And now the pendulum has swung dramatically, and yet we still have, we have very, very, very low rates. It's hard to believe that 10 years or 20 years from now we will have a substantial continuation of negative interest rates. But I've already seen things I didn't think could happen, so who knows what could happen. That's what makes it interesting.
Let's get back out to Omaha, where Becky Quick is with Warren Buffett, and there's a lot of important things happening, but don't forget that March Madness is right around the corner, Becky.
You should see what he's doing right now, Joe. He was rubbing his hands as you said that. Now you're talking his language.
Creighton, it was 70-35 at one point, and I had Creighton yesterday. I don't know if you were paying attention to that. Were you watching that at all, Warren? Nebraska plays tonight.
We pay attention. We pay attention to Creighton out here.
They're good.
We talked about it earlier this morning off camera.
They're peaking. I think they're peaking. I mean, they're getting better and better and better. The three-point shooting was, I think that one guy was 7 for 7 at one point yesterday, which is, I'd be like 7 for 10,000 for three-pointers, I think. Anyway, get back to business. I'm looking forward to it, Warren, and I know we always have our own personal bet. If I get them all right, you give me Berkshire Hathaway, which would be cool for me.
I'll tell you, if you get it all the way, I'll give you my Berkshire Hathaway shares all the way to the 64.
Wow!
Fill out a bracket if it's
giving
perfect.
Pledge.
That's the ultimate giving pledge.
Yeah.
That's how sure he is that you won't be able to do it.
I'm pretty sure.
Andrew, I hear you. I hear you have a question too, Andrew.
I actually have a couple, and I thought that I read the letter like everybody else over the weekend and was fascinated by so many of your comments, Warren. Specifically, I wanted to ask you, you talk about diversity on boards in this letter, and one of the things I wanted you to weigh in on, if you could, is I don't know if you saw, but David Solomon, the CEO of Goldman Sachs, on our air actually, announced a couple of weeks ago that he won't be taking any companies public, Goldman won't, unless they have at least one diverse board member, and are likely going to push that to 2. In the state of California, they put a law into place saying that you needed to have a female board member. And I'm curious what you think of not just the push towards more diversity on boards, but the requirement. Because I also note in your letter that you have very specific thoughts about what it means to be a board member, what it means to be an independent board member, how wealth is involved in all of that. What are your thoughts? Well,
At Berkshire for decades, we've given the 3 factors in addition to integrity, but for board membership, and we want people who are business savvy. We want them to have a strong personal interest in Berkshire itself, and we've got directors who really represent shareholders basically at Berkshire, and I think they do a great job. Now, that doesn't mean that they don't think that we should delight our customers, that we should treat associates well, that we should behave well in our community, both local and national. But our directors represent the shareholders.
So Warren, just to follow up on it though, what's your thought about both the requirement that maybe banks and others, investors are going to force companies to have diverse candidates on their board, laws, as I mentioned, in California?
Yeah, actually, there's been sent to us a proposal which, unless it's withdrawn, will be on our proxy. I can't tell you precisely what it says, but that relates to this issue, and we will get our shareholders' view on it. I personally, and I want shareholders I want directors that represent the shareholders. And, you know, in terms of my estate, you know, with maybe currently $80 billion worth of shares to give to philanthropy, I hope that we have we do have a group of directors that I think will be very conscious of doing the right thing.
The reason I asked the question is because the other point you made, which I think is a very smart one and is often misconstrued in the corporate governance land, is that an independent director these days isn't always independent, in large part, and you make the point that those that don't come to the table with some form of wealth often need the job. They need the money, they want the money, and therefore that makes them less independent. And the reason I ask this is one of the things, as we've been trying to get more diverse candidates on boards, more women on boards, as you know, there are fewer CEOs, fewer people who have made enormous amounts of money, and people therefore then can question their independence. It becomes a very tricky issue, and that's what I was hoping you might weigh in on.
Yeah, Andrew, I've been on 21 publicly owned boards of publicly owned companies, and I've seen them in operation. And I would say that people that I have often seen, and that's perfectly understandable, I have often seen people who are classified as independent directors, and they're getting $300,000 a year for a job that takes them a couple of days, maybe 6 times a year, maybe 4 times a year, and the company flies them to their office, and it's very enjoyable, and the company's good, and who wouldn't want a job like that? I mean, it's an incredible job, and I get calls from headhunters, I get calls from CEOs, and they ask, you know, who I think would make a, quote, good, end quote, director. And what they are asking is, you know, who is not going to cause too much trouble and who is going to reflect, who their name is going to reflect credit on the institution. And they are not looking for somebody that I would regard as really independent. And I don't blame them. I mean, if I had spent my life being a teacher or whatever it might be, I mean, my IQ is just as high as the average or higher than the people on the boards and all that. But on the other hand, I want to get on a board. I mean, $300,000 a year would look terrific, and you don't even have to retire probably in most cases at 65 or anything of the sort. So to call them independent is ridiculous. And if you're on one board like that, you want to really go on another one and make $600,000 a year, and you are not going to do things that irritate your present CEO. So when he or she gets a call and says, "Would this guy make a good director?" that the answer is no. I mean, it's just ridiculous to ignore the factor of compensation with board members.
Okay.
All right, let me ask a follow-up question that is similarly related,
yeah,
Warren, and that's just having to do with sustainability, all these issues that are out there. Guys in the control room, sorry, this is not where I told you I was going, but Abhishek Boudreau wrote in a question. He said, Larry Fink recently said that our investment conviction is that sustainability and climate-integrated portfolios can provide better risk-adjusted returns to investors. What's your view on sustainable investing?
Well, I don't happen to make that decision when I'm buying the stocks in our portfolio. What their individual policies are, I think they're all pro-social. I mean, obviously, you've got to be in tune with your society. But if you think that I look down at a bunch of stocks and decide whether to buy Apple or whether to buy J.P. Morgan, or I'm not using the factors and that he lays out.
Okay. I want to run through a series of questions that have been in. These are kind of all over the map, so forgive me, we'll bounce around, but these are questions that came in from viewers that I thought were good ones. Lucas writes in, he said, did Justin Sun change your mind on cryptocurrencies? For anybody who doesn't know, Justin Sun bought the dinner or the lunch that you just had from the last Glide Foundation fundraiser. He is actively involved in Bitcoin. After that meeting, his PR people put out some notes saying that, you know, you kind of listened to cryptocurrency and maybe you're a little more in tune with the idea of Bitcoin now.
Well, I would say this. When Justin and 4 friends came, they behaved perfectly, and we had a good 3.5-hour dinner, and the whole thing was a very friendly exchange of ideas. But cryptocurrencies basically have no value, and they don't produce anything. So you can look at your little ledger item for the next 20 years, and it says you've got X of this cryptocurrency or that. It doesn't reproduce. It doesn't deliver. It can't mail you a check. It can't do anything. And what you hope is that somebody else comes along and pays you more money for it later on. But then that person's got the problem. But in terms of value, you know, zero.
So it sounds like he did not change your position.
No, but I didn't change his either. And I had a very pleasant dinner, and those people they behaved more than well. And they gave Justin gave $4.6 million to Glide, and that will buy a lot of meals and provide a lot of beds for people in San Francisco. So I thank him.
He gave you some Bitcoin. What's it feel like to be a Bitcoiner?
I don't have any Bitcoin.
You don't?
No.
Okay.
No.
You don't own Bitcoin?
No, I do not own one. I don't own any cryptocurrency. I never will. And you know, in the end, I may start a Warren currency. You know, maybe I can create one, and I'll say there's only going to be 21 million of them, and you can have a little ledger sheet from me and everything that says you have it, and you can have it after I die, but you can't do anything with it except sell it to somebody else. And the interesting thing, of course, is that Bitcoin's been out there a long time, and people talked about how it would be used in various kinds of exchange, but none of our companies are doing business in Bitcoin or anything. Yeah, Bitcoin has been used, I think, to move around a fair amount of money illegally. So the people
or maybe in countries where you have
yeah. So the logical move from the introduction of Bitcoin is to go short suitcases, because the money that was taken in suitcases from one country to another, suitcases will probably fall off in demand. I mean, so you can look at that as the economic contribution of Bitcoin to the society.
All right, let's talk about a question that comes in from Rusty Thomas, and he's got a question on baseball. He said, given Warren's love of baseball and the contrast between his deft management of the Solomon Brothers scandal and Major League Baseball's inexplicable mismanagement of the Astros sign-stealing debacle, what advice would Warren provide MLB Commissioner Manfred to restore confidence and integrity in the game?
Yeah, well, it survived the Black Sox scandal back around 1920, and people will continue to love baseball. But you know, it was one thing to steal signs if you were on second base, but it's bad. Baseball will get past this.
You're a huge baseball fan. Were you?
Pardon me?
You're a huge baseball fan. Were you surprised to hear about?
Yeah, I was surprised to hear about it. Yeah, but then I found out that Bobby Thompson's home run. You know, somebody just stole the sign. I think off Ralph Brink or somebody. You know, so people are going to, in any games, including the stock market game, you know, a certain number of people cheat, and generally we have people that administer things to try and minimize the cheating, and I'm sure that Major League Baseball will address the problem.
Should the Astros players get off scot-free?
Oh, I'm not going to make a judgment on that, but Joe Jackson certainly didn't.
Yeah. Let me ask you about a question that came in from several viewers, actually, and that's about ETFs. DeMosley Management wrote this version of the question, and news agencies have reported that Berkshire Hathaway purchased 2 ETFs. So can you talk about if this purchase happened, and if the purchase happened, who purchased the ETF for Berkshire Hathaway, and how was the decision made to purchase it?
Yeah, it wasn't me. It wasn't me, or it wasn't Todd, or it wasn't Ted, and it happened in some pension fund, and we have a few pension funds that aren't actually managed by us. But all I can tell you is that nobody that manages money at Berkshire is buying ETFs, nor do I see any possibility that they will.
Another purchase that came up recently, Kroger. And Jason Escamilla writes in, was that one of yours or a lieutenant's pick?
It was one of the others. You know, I know Kroger. Kroger's done a good job, but it's in a very tough business. I mean, when you have Amazon and Walmart slugging it out and Costco taking a special part of it and everything, it's a tough business, but they've done a good job. And one of our managers decided to buy that.
Okay. And then Kraft Heinz. This comes in from David Hall. He says, Mr. Buffett, while Kraft Heinz continues to whittle down their total debt, do you feel that the current dividend payout is appropriate, or should it be reduced further to free up more cash flow to reduce debt more rapidly?
I think Kraft Heinz should pay down its debt, and it should. But I think under present circumstances, it appears that it can pay the dividend and pay down debt at a reasonable rate, and it has too much debt, but it doesn't have debt it can't pay down, and the debt holders are going to get the interest, and the debt should come down year by year. And I think it will, and I think it can with the present dividend, but who knows for sure in the future.
Theo Philos writes in a similar question and says, do you still believe in the company and management at Kraft Heinz?
It's still a great business in the sense that it earns, we'll say, $5 billion after depreciation, pre-tax, on $7 billion of tangible assets. It uses about $7 billion of fixed assets. It has no net working capital. I mean, it's a very valuable business, but we paid too much for Kraft, and we took on more debt in that, but we paid too much.
Another question comes in from Beal, again on Kraft Heinz, and this person writes in, private labels have performed very well against brands like Kraft Heinz, but they haven't made a dent against other brands like Coca-Cola or See's. Why do you think that is, and how do you think about brands' moats, given your experience with Kraft?
Brands are always going to be in a fight with the retailer, and it varies by country enormously. It varies by product category. If people, I worked in a grocery store in 1941. Charlie worked in State One in 1940. People would call in, they'd ask for a can of peas, and I'd write down a can of peas. They'd call in and they'd ask for Heinz ketchup, and I better give them Heinz ketchup. They didn't care which brand the peas were. They didn't care that much whether the 2 quarts of milk we sent them were this brand or that brand, but they cared whether it was Heinz ketchup. That was it, 1941. Some brands are terribly strong. You can't bring out a private label cola and do very well with it, and people have tried for a long, long time. On the other hand, you can bring out private labels in lots of products, and they sell very well. And you take Costco with their own Kirkland label. I mean, that label grows dramatically. It cuts across categories. It's done since 1992 or whenever it was introduced. Other people spent 100 years, with huge amounts of advertising and special display, all kinds of things. So the battle goes on. I would say that the retailer has gained ground against brands to some degree, but brands are still terribly important. I mean, try and give me a $10 billion budget and ask me to bring out another Coca-Cola that makes a dent in Coca-Cola, and I can't do it.
Warren, one of the questions that did come in, it was something that you wrote about in the annual letter, was the role that Greg and Ajit play. Greg Abel, Ajit Jain, the 2 vice chairmen who were recently added as vice chairman, the role that they're going to be playing in the annual meeting with shareholders. You said that they will play a larger role in the shareholder meeting. How will that work?
Well, it will mean that any shareholder or any of the journalists there who are presenting questions from shareholders that have been sent to them can direct those questions to either Ajit or to Greg. So if they were insurance questions, they might want to direct them to Ajit, non-insurance questions to Greg. But they will be there, and we'll have 60 or so questions. We don't know what they're going to be, and if anybody says, I would like Greg to answer this, or I would like Ajit to answer this, then they're right there adjacent to us.
They'll be sitting on stage with you and Charlie?
Well, there's this Yeah, well, he's sitting in front of the crowd. There's two different levels and tiers there. Mm-hmm.
Yeah. Again, you said you did this because you'd gotten a lot of questions from directors, shareholders, other people who had kind of advised you that they thought it was good for them to be playing a bigger role.
Everybody. I heard from quite a few people. Now, we directed questions out to them where they were sitting with the directors out in front, and then the spotlight went down. But this may encourage more questions directly of them, and that'll be terrific.
Okay. Jim Bean writes in a question. He says, in the past, both you and Bill Gates have stated that half of the board meetings are spent discussing succession. How has this changed since Ajit and Greg are on the board? Do they leave the room?
They leave the room. But if I die tonight, the board tomorrow morning knows exactly what they're going to do. Hope they're polite about it, let the body cool off. But basically, they know what they're going to do. And the interesting thing about it is, we own the Apple and J.P. Morgan, all those things. I don't know who's going to succeed the CEOs of any of the companies I think that we own stock in. But we're well prepared for succession. It's almost going to be embarrassing how well.
All right, let's get to a few more shareholder questions. Chip Crook writes in a note and says it was reported that Boeing was looking for a large cash loan. Were you ever approached about Berkshire loaning the money, kind of like the Goldman Sachs deal from years ago?
I think Boeing's raised about $13 billion, but that's bank type money. In other words, my memory is that it's maybe 1%, plus liability. They're looking for traditional bank loans, and we don't make traditional bank loans.
You also talked in the letter about how Berkshire Hathaway Energy, has the ability and the talent to manage big investments, $100 billion and more. I think you wrote, "We stand ready and willing and able on such opportunities." California Governor Gavin Newsom asked you at one point to bid on PG&E. Is that such an opportunity?
PG&E, we worked with them for decades and been familiar with them, but that doesn't fit Berkshire. But if there were $100 billion of transmission lines or whatever it might be, Berkshire could do it. And we would love it. That happens to be a very tough thing to do because you cross all these states and everybody says, not in my backyard and all that. But there can be huge, intelligent investment made in the utility energy area, and no one is better equipped to do it than Berkshire in both talent and resources.
Why does PG&E not fit that bill?
It's too tough. I don't know the answer to it. Rearranging that utility. I know Governor Newsom. I think he's a very, very, very smart guy. And in terms of solving this problem, it's just not easy. You've got so many constituencies, and they're at each other's throats, and there's lots of money involved. And I don't want to be the guy. I don't know how to solve all that.
Okay. Let's go on to a question that is posed by Ken Ducey. He says, you sold 31 newspapers after buying them over 40 years as a self-described newspaper addict. You said recently that most newspapers were toast. I know that's not exactly what you said.
Yeah, that's not true.
But this is in his question. You can answer that too. Do you believe the problem with local newspapers is a lack of demand or a lack of innovation and a new business model?
Well, the problem is that, getting back to the toast comment, Andy Sherware actually is the fellow that said toast. He was interviewing me and I repeated it. But the problem is, and even every day, the circulation of the papers in every print circulation goes down. And the interesting thing about it, of course, is that the three survivors so far that look promising online are the New York Times and the Wall Street Journal and the Washington Post. All three of those papers sold their smaller papers. The New York Times sold, I think, 11 papers about 7 or 8 years ago. The Dow Jones, which owned the Wall Street Journal and now is owned by News Corp, they sold the Ottaway newspapers, 8 papers. Washington Post sold the Everett Herald. So they all saw the handwriting on the wall before I did, and they all sold their papers. That was their reaction. They did not try and figure out the online solutions. They got out of them, and unfortunately, I I bought some, and we're still in it. I mean, we are financing Lee, and we think Lee has by far the best opportunity to continue print as long as anybody and to find an online solution for these papers. So we put new money into the newspaper industry here, or we've committed to do it. It'll close in a month or two.
And then finally, very quickly, we are in the Berkshire Hathaway's headquarters building here in Omaha. Strom writes in a question that says, why did you decide to rent your offices for all these years instead of buying the building or building your own office building?
Well, we only use one floor of the 15 floors here, but we have signed a lease for the next 20 years on one more floor, so it shows just how flexible our thinking is about the future.
How much growth you're anticipating?
Yeah, we don't want a big headquarters office. If we had a big headquarters office, we'd fill it, believe me. I mean, if we had 15 floors of our own, we'd have 15 floors worth of people.
Warren, before we let you go, let's just go back to the futures again this morning, because right now the Dow is indicated to open down about 830 points. Weakness again on concerns about coronavirus and what that means. What's your mentality today as you kind of go out and look at the stock market and decide what you're going to do?
We're buying businesses to own for 20 or 30 years. We buy them in whole. We buy them in part. They're called stocks when we buy them in part. And we think the 20 and 30-year outlook has not changed by coronavirus.
All right. Warren, I want to thank you for your time today. We really appreciate it, your generosity with your time, and we hope to see you again soon.
Come every year.
Thank you.